Ladies and gentlemen, before we begin this event, allow me to inform you several guidelines during this session. You may type your questions via Q&A feature with format name_institution name_speakers_questions. All the questions can be submitted in English and Bahasa. We also provide interpreter feature. Please choose the language that you want. Thank you and hope you enjoy the discussion.
OJK memiliki visi dan komitmen yang kuat dalam pengembangan sumber daya manusia sektor jasa keuangan secara berkelanjutan, guna mendukung terwujudnya industri jasa keuangan yang stabil, kontributif, dan inklusif. Kami sadar, dalam mewujudkan visi tersebut, peran SDM yang unggul dan kompeten menjadi kunci utama. OJK Institute hadir untuk menjadi Center of Excellence, guna mendukung pengembangan sumber daya manusia sektor jasa keuangan dan melakukan riset-riset yang inovatif dan terkini. Pengembangan sumber daya manusia sektor jasa keuangan yang kompeten dan profesional menjadi salah satu faktor penting dalam mendukung keberhasilan kinerja lembaga jasa keuangan. OJK Institute memiliki 3 fungsi utama. 1. Mengembangkan kapasitas SDM sektor jasa keuangan melalui penyelenggaraan program pelatihan, seminar, dan workshop. 2. Melakukan riset yang inovatif dan visioner. 3. Merancang dan mengembangkan standar kompetensi SDM sektor jasa keuangan, serta melakukan penata laksanaan lembaga sertifikasi profesi. Dalam rangka meningkatkan kompetensi SDM di sektor jasa keuangan, OJK Institute menyelenggarakan berbagai program capacity building, baik dalam bentuk workshop ataupun webinar. Menghadirkan narasumber terbaik yang memiliki keahlian di bidangnya, antara lain bidang perbankan, pasar modal, IKNB, teknologi digital, dan lain-lain. Riset di OJK Institute berbasis akademik dengan memperhatikan perkembangan terkini. Penyusunan riset menghasilkan temuan dan rekomendasi yang mendukung kinerja sektor jasa keuangan. OJK Institute juga menyediakan perpustakaan digital e-library OJK yang mengelola koleksi buku digital, koleksi internal OJK, koleksi buku fisik, dan koleksi e-resources mitra OJK. Selain itu, manfaatkan juga aplikasi e-lib OJK untuk membaca e-book melalui smartphone. Mini site OJK Institute tersedia sebagai portal media digital untuk mempermudah publik mengakses berbagai informasi kegiatan OJK Institute terkini. Selain itu, OJK Institute juga membangun knowledge management system sebagai media pembelajaran dan pertukaran knowledge secara digital yang dapat diakses oleh seluruh SDM sektor jasa keuangan. Indonesia saat ini telah menerapkan strategi pengembangan SDM berbasis kompetensi. OJK Institute bekerja sama dengan instansi-instansi terkait dalam menyusun suatu standarisasi kompetensi yang disebut dengan SKKNI, yang kemudian diturunkan menjadi KKNI. SKKNI dan KKNI dimaksud digunakan oleh lembaga sertifikasi profesi atau LSP dalam penyusunan skema sertifikasi, pengajuan rekomendasi, dan pengajuan pendaftaran ke OJK. Selain 3 fungsi utama tersebut, OJK Institute juga berfungsi sebagai license officer, praktek kerja lapangan, visit OJK, penelitian mahasiswa. OJK Institute memfasilitasi program praktek kerja lapangan di lingkungan OJK bagi pelajar dan mahasiswa. OJK Institute juga menerima kunjungan lembaga pendidikan yang ingin memperluas wawasan bidang tugas dan fungsi OJK serta sektor jasa keuangan. Selain itu, OJK Institute senantiasa memfasilitasi mahasiswa dalam hal penyediaan data atau informasi terkait dengan tugas dan fungsi OJK. Dalam rangka mendukung pengembangan SDM sektor jasa keuangan, OJK telah menerbitkan Cetak Biru Pengembangan Sumber Daya Manusia Sektor Jasa Keuangan 2021-2025 pada 25 Mei 2021. Cetak biru tersebut memiliki visi, yaitu mewujudkan SDM sektor jasa keuangan yang profesional, berintegritas, dan berdaya saing global dalam rangka meningkatkan kinerja sektor jasa keuangan. Visi tersebut dijabarkan dalam 4 pilar misi, yaitu 1. Mengembangkan standarisasi kompetensi SDM. 2. Mengembangkan metode peningkatan kompetensi SDM. 3. Mengembangkan infrastruktur pendukung pengembangan SDM. 4. Mengembangkan SDM yang memiliki kompetensi digital. Implementasi cetak biru ini kemudian dituangkan ke dalam 21 program kerja yang akan dilakukan dalam kurun waktu 5 tahun dengan melibatkan peran aktif dari industri, akademisi, OJK, dan lembaga lainnya. OJK Institute memiliki komitmen yang kuat untuk melaksanakan cetak biru tersebut bersama-sama dengan pengawas, industri, akademisi, dan pemangku kepentingan lainnya. Cetak biru tersebut diharapkan menjadi kerangka acuan dalam mendukung pengembangan SDM sektor jasa keuangan. OJK Institute, Center of Excellence.
Ladies and gentlemen, we are now singing to our national anthem, Indonesia Raya. Let us all rise. You may now be seated. Assalamualaikum warahmatullahi wabarakatuh. Good afternoon, salam sejahtera, Om Swastiastu, Namo Buddhaya, salam kebajikan. Honorable Chief Executive of Banking Supervisor Indonesia Financial Services Authority, Bapak Dian Ediana Rai, Director of the Center for Digital Banking and Finance, Mrs. Helen Panzarino, LIBF Adjunct Faculty and Speaker, Web3 Labs, Mr. Connor Svensson, LIBF Guest Speaker, Crypto and Data Science, Mr. Eduardo Litonjua, Deputy Commissioner of OJK Institute and Digital Finance, Bapak Iman Shah, Head of OJK Institute, Bapak Agus Sugiarto, Director Financial Services Sector Development, Bapak Hikmah Rinaldi, Executive Senior Analyst of OJK Institute, Ibu Ninyoman Puspani, leaders and employee of OJK, leaders of Financial Services Industry, Financial Services Industry Association representative, distinguished guests, ladies and gentlemen. Welcome to the Metaverse in Banking, Thursday, September the 15th, 2022. Thank you for your enthusiastic. There are 2,774 people who will join this webinar. The majority comes from the banking sector, around 47%, the non-bank financial industry, around 17%, others around 11%, academy around 9%, OJK around 5%, the government institution around 4%, and the capital market sector around 4%. Ladies and gentlemen, before we begin, allow me to run through quickly our agenda today. Opening remarks by Chief Executive of Banking Supervisor Indonesia Financial Services Authority, presentation and discussion led by the moderator, followed by questions and answer sessions and closing. Distinguished guests, ladies and gentlemen, we are now opening today's event with the welcoming remarks by Chief Executive of Banking Supervisor Indonesia Financial Services Authority, OJK. Please welcome Mr. Dian Edianarai.
Dear my fellow speakers, Mrs. Helena Panzaya Rino, Directors of the Center for Digital Banking and Finance, Mr. Connor Svensson, LIBF, Adjunct Faculty and Speakers, Mr. Eduardo Litonjua, LIBF's Guest Speaker, Crypto and Data Science, OJK Institute, who have organized and prepared this webinar excellently, and webinar participants and academics who have gathered here today. Assalamualaikum warahmatullahi wabarakatuh. Good morning, peace and prosperity be upon us. Om Swastiastu, Namo Buddhaya, my benevolence greetings. First of all, let us give praise and gratitude to Almighty God for only His permission that we are able to gather in this virtual meeting to take part in the webinar Metaverse in Banking. On behalf of the members of the Board of Commissioners, the Financial Service Authority, we express our gratitude for organizing this webinar event, which is one of the efforts to encourage the financial services sectors, especially banking sectors, in developing our country economy. We would also like to express our deepest appreciation to the speakers and moderators who are willing to take the time to share their knowledge and experience in their respective expertise, which will certainly be very beneficial for stakeholders, including us as regulators. We would also like to express our appreciation to all participants who have enthusiastically attended this morning's webinar. Dear ladies and gentlemen, Metaverse is the digital phase of an augmented reality, technology that allows individuals to interact with other individuals virtually and can be implemented on the internet as a simulation of the real human world. The literal meaning of the metaverse comes from the combination between the two words, which are meta, which means beyond, and the word verse, which means universe. According to Forbes 2021, the metaverse is a potential network of 3D virtual worlds on the internet that are typically designed to be highly social and require users to have a virtual identity, often through an avatar with certain attributes within this world. The metaverse provides a sense of ownership over virtual goods such as digital land, building, and artwork because of their own separate virtual economy. In the metaverse ecosystem, users can use a token as a payment instrument for transaction. It certainly attracts several sectors, such as the information technology, education, finance, and health sectors that are becoming increasingly aware of the investment value of the metaverse. These sectors are actively trying to explore future opportunities involving the metaverse as a new business opportunity, the huge economic potential in the virtual world allow metaverse technology to grow even further in the futures. The popularity of metaverse has been skyrocketing since Facebook founders Mark Zuckerberg changed his company name from Facebook Incorporated to Meta Platform Incorporated. This was done for several reasons, including wanting to have a new brand that aligned with his futuristic vision to build the metaverse. Metaverse technology, with its immense experience, is considered to be able to minimize the gap between reality and the virtual world that allow banks to reach new customers who cannot or are not willing to go to the banks, branch offices, and offer a different customer experience. Dear ladies and gentlemen, in the report released in June 2022, McKinsey & Company mentioned that the metaverse market value has potential to grow to around 5 trillion by 2030. In addition, the McKinsey & Company, Citigroup, and Goldman Sachs also share similar outlook on the metaverse. Citigroup's estimate that the metaverse has the opportunity to grow to around 13 trillion US dollar industry, with the 5 billion individuals partaking in it by 2030. Meanwhile, Goldman Sachs sees the metaverse has the potential to grow into 8 trillion industry. Seeing the huge potential that the metaverse has, many companies are competing to enter this new world. One of is the global accounting firm KPMG. The firm, which is one of the members of the Big Four, decided to enter the metaverse by building a collaboration hub with investment of around $30 million between KPMG and KPMG Canada. In the banking sector, metaverse is considered to have an enormous potential following the development of technology and information. With the virtual reality technology over, metaverse has become an attractive avenue to explore for the banking industry, which plan to launch digital banking services while still blending in a human touch in it. The development of the metaverse was done to offer a new experience to customers by presenting various banking services that can be experienced in the virtual world. This can be done by combining the three latest technologies, namely virtual reality, augmented reality, and artificial intelligence. Based on JP Morgan's report, there are three key success factors for the development of metaverse, with a robust and flexible financial ecosystem, seamless connection of the physical to the virtual world, and the real-world economic elements, including population, GDP contribution, and currency. In its report, JP Morgan mentions that while the metaverse provides unique new ways, services, and business models, not everything in the metaverse will be relevant for every business. Before entering the world of the metaverse, an enterprise need to consider the following. Bank must learn various aspects of metaverse. Banks need to evaluate the relevance of metaverse toward their business. Next is create, which explore creative customer engagement through new channel, services, digital goods, experience, and asset. And really, in relation to the connection, banks have to start building a suitable ecosystem for metaverse through next generation recruitment. Lastly, established banks need to conduct business activity through engagement with the sub-communities that are technologically well advanced. Dear ladies and gentlemen, as a closing statement, in responding to the rapid and massive technological developments, OJK is always open and will always strive to accommodate every innovation created by the financial industry. However, we should also remember that OJK's main purpose is to maintain the stability of the financial services sectors, including anticipating risks that may arise due to technological development. OJK always pay close attention to the developments of the industry practices, including technological trends that are developing around the world, and always conducts in-depth studies to support financial services sector policymaking. Before ending this opening speech, I would once again like to express my appreciation to all participants, the organizing committee, and especially appreciation and gratitude to my fellow respected speakers. Hopefully the result of this webinar can provide great benefits for the financial services sectors and the Indonesian people in general. Finally, I wish this webinar will have a fruitful discussion and enjoy the webinar, everyone. Thank you. Billahi taufiq wal hidayah. Wassalamualaikum warahmatullahi wabarakatuh. Dear my fellow speakers, Mrs. Helena.
Thank you very much, Bapak Dian Ediana Rai, for such a warm welcome. Due to attending other agenda, you may now leave the virtual room. Once again, thank you for your presence at this event. Distinguished guests, ladies and gentlemen, we have come to the main session of this webinar. There will be questions and answer sessions. You may type your questions via Q&A feature with format name _ institution name _ speakers _ questions. All the questions can be submitted in English and Bahasa. At the end of the session, we will share link of materials and feedback form. Please fulfill the feedback form before Friday, September 16th, 2022 as requirements to get a certificate. Ladies and gentlemen, we would like to invite our first speaker for today's event, Mrs. Helen Panzarino, Director of the Center for Digital Banking and Finance. Originally a commercial banker, Helen is an experienced fintech Sherpa, program director, excite entrepreneur, educator, and author. Helen specializes in fintech banking partnerships and guiding financial institutions to the digital future by connecting them to the fintech of the present. A regular judge, speaker, and moderator for the Banking and Fintech Awards and conferences, Helen was a BSI Fintech representative for the UK in Brussels and has been named on the Computer Weekly 100 Women in Tech and Innovate Finance Women in Fintech Power List. Her new book is Reinventing Banking and Finance, Frameworks to Navigate Global Fintech Innovation, was named Banking Book of the Year by Investopedia in 2021 till 2022. Ladies and gentlemen, please welcome Mrs. Helen Panzarino.
Thank you very much, Vera. Thank you. Welcome. Thank you very, very much. Welcome, everyone. Thank you for having us as well. That was a fantastic introduction, and it sets the scene very well for not just the content and context, but also for understanding why it's important and why it's important in your careers. And of course, we collaborate with OJK at the London Institute of Banking and Finance because we are really in the thick of the market, and everyone we know is working in this to further their careers. I'm going to share my screen. Hopefully, let's see if the technology will work with us today. Let's try. Okay, let's see if we can get to the sharing screen. Can everyone see what I'm seeing now? I hope. Okay. I also just want to say before I start that for obvious reasons, the whole of the United Kingdom is online. And I hope that I won't lose my connection at various times, but just in case, it's a very busy time online. We've set the scene, obviously, for metaverse and banking and metaverse and finance and metaverse and learning and going forward. And before we get into the thick of this content with Connor and with Eddie, I wanted to just take a step back and to look at what's happening in the global megatrends in fintech. it's important for all of us to just take a step back and understand what's happening around the world. It impacts us because we live in a global market, don't we? And it's good to see what's going on in addition to the metaverse, NFTs, cryptocurrencies, and we will touch on that in a minute as well. Okay. So you've had the introduction to me. You know that I'm the director of the center. I also work with a number of fintechs who are, let's say, dabbling into different aspects of the metaverse and banking. And so it's good for everyone to stay current. And I try to keep on top of that with you as well. But as I look around the globe, and I'm looking in the UK, of course, as well, there are things that have happened as a result, obviously, of the pandemic that have put a strain on business models for a number of what we would see, for example, as challenger banks. We're seeing changes in the infrastructure, and fintech is starting to come forward in building the infrastructure, not just in the banks in that space. We're looking at different forms of finance. We've had a conversation already about embedded finance, I know, with OJK in a webinar, and buy now, pay later is part of that discussion. What is it? What's happening with it? Why should we care? And what are the challenges around that? We should never ignore that big tech is always getting involved in banking and finance. And of course, as we just mentioned, with Meta, erstwhile Facebook, now in the metaverse firmly, there are various aspects of big tech that are going to influence what we're talking about today. Cryptocurrencies as the currency of Web3, and I know Connor and Eddie will get into this, but the volatility of cryptocurrencies, how does that play out from a regulatory point of view and from us as users in this new metaverse or Web3 infrastructure environment? Regulation is accelerating many trends around the world, one in particular, open banking, and of course, digital currencies as well. The FinTech's global march is not just limited to us and to the UK, is it? It's around the world. And if we have time today, I'll touch on regional variations. If not, you'll get access to the slides as well. And of course, from an investor point of view, we will all be aware that we're seeing investors, particularly the mid to later stage investors, are starting to pull back from putting money in at the early stage of fintech. What are the implications of having a funding environment that is only at one end of the spectrum and not funding the beginning? So we'll have to look at that as well. And we'll see how long will that carry on and what are the implications of that bear market carrying on as well. So again, just a bit of a content and that look at what we'll talk about today, just a bit of a recap there. And as I said, if I have time, I'll look into the regions. So trend number one I want to talk about is signs of an overheating environment in fintech emerge. And this is really speaking to that funding aspect of it. You see at the bottom of this slide where it says Tiger Global, which is not obviously a venture capital fund, but obviously much larger than that, is hit by 17 billion losses in the tech rout. Hedge fund suffers a breathtaking drop as speculative stocks sink from the pandemic peaks. What is this about? This is about this market in fintech. Has it overheated? Have the valuations been too high? Has too much money gone into it when there are surge times in the market? We saw something similar in 2016 when there was a retraction in the market, as we're seeing now. But what the question is again, with larger investment rounds, 100 million plus investment rounds at later stages, what happens at the early stage and how will that impact as we go along in the funding journey? Will we get new fintechs in? How does that impact going to market for IPOs, for example? How does that impact growth in terms of global growth? And how does that impact the number of people that can be hired and what that means for people coming into the markets? We're seeing global seed and angel investment drop. Now, I've been here before, and this comes in a cyclical trend where there's a retraction in the markets and investors go into that bear mode. What I'm saying is that we need to look at how we can get the whole of the market from early stage all the way through to going to the actual financial markets. We cannot ignore that early stage. It will have an impact later on. In terms of the embedded finance side of things, we're also seeing that there are the collapse of certain industries. Now, buy now, pay later, which particularly in Australia, for example, took off in a very big way, we're now seeing that really we're seeing companies close, we're seeing companies merge. Now, this is a trend I think that will continue not just for 1 year, but probably for the next 2 or 3 years. But what does that say about the fragility of fintechs that are going to go to the market later on? We have these surges in valuations, and then we have these massive drops. The volatility has to impact what's happening in the wider fintech world. So embedded finance, yes, it's come to market, and it's definitely here to stay. And there are big tech involved in this, as well as there are banks in fintech. But it also draws attention, and of course it should draw attention of the regulators, because we have to protect the communities and protect our people from understanding the products and services that they're into. I want to speak here just for a minute. I've got Chief Mindset Officer down here. One thing that's happened, and particularly embedded finance driving this, is that in banking and finance, you have to kind of switch your mind now. Brand has become much more important. And I'm not saying it's more important than banking, but there will be what was maybe the marketing officer is now drawing together all the stakeholders, internal and external. And there's a mindset that is more akin to what we would know possibly as e-commerce or retail. So we have to shift our mindsets to understand that our customer, particularly our younger customer, is now looking at us as a brand, and they're comparing us as to brands. So keep that in mind over the next 2 or 3 years as you go along as well. You want that bottom line, that embedded product. I don't want to leave one website to go make my payment. I want to stay there as a user. I'm on the platform. I want to make the transaction there. More and more, this is going to impact banking. And whether banks actually decide to adopt themselves embedded finance, and that seems to be the way we're going. This is the alarm for that to happen. As I said before, it also draws attention. Now, around the world, buy now, pay later as an embedded form of finance is coming in different stages. But one thing that has become clear is that consumers don't always understand that it's credit or it's debt. And the fear is that we will start to put people into a debt situation that they don't understand and they can't get out of, with the winds of economic change that we have now in the background. So watch this as it goes out around the world. What will happen, I say now, is that we'll see more regulation coming. It will start in the UK, and then it will spread around the world, because regulators need to protect the consumers. And I don't think consumers completely understood this. On a positive side, I think buy now, pay later for businesses, enabling supply chains to open up more, trade finance to open up more, lending to open up more in real time. That's where this is going to go, in my opinion. So you will have obviously examples like Klarna, which is the Swedish company that's one of the most well-known companies in the buy now, pay later space. They've had significant losses. They've had valuation drop, and they are under the microscope of the regulator. They say they welcome it, but again, it's something that really surged during the pandemic, and going forward, it will have to cool off a little bit. Challenges, whether neobanks, digital banks, platforms that use banks as sponsored banks behind them as a regulated environment, are all coming under the microscope. Investment in these organizations needs to show a return at some point. The pandemic gave a surge in digital banking, mobile banking, because obviously people couldn't go to a physical bank branch. But some of them have shown that their business models have not stood up. Now, going forward, where is the trend going? It looks like it will go more towards digital banking, rolling out into the small business, the SME, the SMB world, because they have been less catered to in a specific way when it comes to digital banks. But there has been a bit of a crisis in terms of the business models. If you went from freemium to subscriptions, for example, with a neobank, how does that play out with a customer base that may not have the funds to want to take part in that? How does a very slim margin, for example, on a referral from a platform impact the business model? This is a super opportunity for incumbent banks, for the larger banks, the global banks, to really get on board with really lifting up their digital proposition, their mobile proposition. Because a traditional bank has a traditional banking model where they lend, for example, and they have fees or they have interest depending on where they are in the world. And that's pretty much the core of the business. This doesn't happen in the neobanks. They're taking slices. They're not lending as much. They're taking transaction fees. They're taking subscription fees. Now we're seeing a trend of everyone moving into offering insurance and wealth and robo-advisory in fiat currency and also in cryptocurrency. And that has its own things that we need, challenges that we need to keep our mind on. Some are more successful. Some of you may know Sterling Bank from the UK. It was one of probably, if not the first, one of the very first digital banks with a banking license that came to market. But where will they go? Their revenue streams come from faster payment services. It comes from obviously lending. It comes from subscriptions. They've had huge amounts of investment from other banks, for example, like JP Morgan, Goldman Sachs. JP Morgan is interested in looking at them as a takeover proposition, so we hear. But the important thing here is that neobanks are squeezed between diversifying and returning value to their investors. It's one thing to have a younger target market who works to usage versus loyalty. There are other parts of the market, like small businesses, like in certain parts of the world, there's an older generation that has more wealth that isn't being catered to. So they need to have a business model that's robust, but they also need to look for where the trend is taking them for their next customer base, because ultimately their investors are going to look for a return. It hasn't always played out well. In Australia, for example, we've had many faltering moments, let's call it, and we've had a couple of the very well-known neobanks close and one being absorbed by a larger incumbent bank. But we don't actually know how that will work out because there are two different cultures there. What's important for these neobanks is to understand that they need to prove their business models. They need to look for other niche markets as we go forward, and they should not ignore the small business as well. Infrastructure, which traditionally has come from core providers, for example, and we know this in our incumbent banking platforms, has now got fintech coming in and growing in prominence. It's not just the front end, the user experience. We're seeing the middleware and the backware, the coreware, starting to be infiltrated by fintechs. So we need to be aware as the banking industry that it's not all our own space anymore. Now, some of the incumbent banks like BBVA, for example, have also come out with other propositions in the banking as a service environment, sensing the trend, sensing that fintech was invading their space. They decided to get on board with it because it's better to have some market and some margin than to be ignored entirely. But that needs agility. That needs leadership at the top that will say, we shouldn't just stay still. We need to be able to act, and we need to be able to act quickly. White label embedded finance, obviously, and that's the pipes, if you like, of banking is one area where we're seeing the fintechs really come into this space. You can either have a full stack infrastructure, for example, you can have other banking license providers, you can have banks themselves getting involved. But what to understand here is that the previous trend of unbundling is now coming back to rebundling, but the rebundling is being done by the fintech space, not necessarily by incumbents themselves. Plaid is one of the very well-known pipes, for example, in this infrastructure space as well. They act as an open banking API construct, for example, and they came under the attention of Visa, who wanted to buy them, but it was deemed to be not competitive enough. And in the end, they purchased someone else called Tink. So big tech and big finance, again, prepare for the super app. Now, some of you also, I know, will follow along, for example, with Revolut, who were born in the UK, but are a global organization now in the banking space. They lay out their stall that they want to be a super app. The super app, which of course in Asia is a more well-known proposition, business model, where I find all my finance and I find all the things that I want to finance all in one space from one provider with partnerships that are accessible by APIs, for example, is less known in this part of the world, or for example, in the United States. But the question becomes, me or you as a client, as a customer, as a user, why do I want to leave my banking app or my finance app to go do something that if I, for example, I want to go on a holiday, if you got a relationship with a booking organization and a foreign exchange organization, I will stay and be sticky and stay on your app, get my foreign exchange, book my holiday, all in the same place. This concept of having the data, having the understanding, having the right partnerships, we're now seeing this happen more and more and spread around the globe. Of course, today we're talking about the metaverse and banking. We're talking about Web3, and we're talking about NFTs and crypto and a blockchain, which when I first remember people talking actively about it in 2014 was kind of a side discussion. Now is becoming much more embedded in our discussions. And I know Connor will speak to you about Web3 and the infrastructure around Web3 and decentralized finance. And Eddie will touch on smart contracts, for example, as well, which we can see as a threat or something to be aware of as traditional banks, because they can be replacing, in this case, traditional guarantors. But we do need to understand this decentralized financial environment and what are the risks and the challenges from users' perspective, from regulators' perspective, what are the opportunities and where are we at in this development? We started this day off talking about the fact that KPMG are in there, some of the larger banks are here in for example, in the metaverse. But what does all of that mean for us? Is it really well developed yet, or are we at a very early stage? But we should not ignore this trend. We need to be aware and understand and to be in it. We've understood, we've had discussions now already about what the metaverse is, and I'm not going to steal anyone's thunder, but let's just say it's not just about playing games, although we see games in the metaverse. It's health, it's learning, of course, it's meeting space, it's meeting with friends. It has many, many opportunities, and we've understood that there's a great wealth value that could be attributed to this. But we also have to understand where we are in the development, both technologically and also as users of this. So again, I will let Connor and Eddie, in the interest of time, I'll let them go further into detail with this. But I think the client relationship and that management is something that we need to be aware of with this trend. I'm just going to, we know that, for example, we've seen the KPMG discuss, JP Morgan also has a lounge. And of course, and as mentioned earlier, there's a real estate element to this. So everyone's getting in early, they're putting their money down, they're buying their space. But am I just passing by, or am I just going in for a meeting at this point? What will be this trend developing over these next 2 years? And Connor and Eddie will tell you more about that. We have a little time for a look at regional trends, because things do play out in fintech differently around the world. And in Europe, we are still looking at regulation, and particularly in the payment space, as something that is still very topical. So and again, whether or not this super app will come to bear, we have regulation from Europe, in Europe itself, in the EU, on crypto now. The UK is looking at this. We have now a change of government. We have now a new chancellor. We'll see how this plays out and whether or not the UK continues to want to be leading in the crypto space. In the USA, they're not that far behind anymore, but the SMB or SME market is the one that is going to come forward in the next year or two. Why? Because most of the world sees the SME market as the way out of the economic crisis and out of the problems with the pandemic. What we don't know yet is how strong these companies will be when all of the safety nets of government support have gone. What we do know is that now and in the next 1 or 2 or 3 years, we're going to see a significant uptake in mergers and acquisitions and in consolidation. And not just from the top buying the bottom, but sometimes you'll see the fintech or the neobank buying the larger players or coming together with the larger players. The level of bank that is tier 2, tier 3, much more active. And watch that over the next year or two. They're coming together to invest in fintechs. They're coming together to invest in technology. They're coming together to create their own technologies. So whereas 3 or 4 or 5 years ago, they were behind, now they're picking up pace. MENA continues to thrive, particularly in the scale-up area of fintech, but also now we're seeing the launch of new neobanks, some state-funded and state-backed, some in the private sphere. What strikes you from MENA is that there's an incredible amount of funding going into companies, both public-private partnerships, and that will continue. We're now seeing organizations like Stripe invest in MENA. We're now seeing Accords, for example, with Tel Aviv. Where will these technologies play out? I imagine in the next year or two, this will only continue to grow in the scale region and will act also as a springboard for other parts of the world, like Africa. Asia, obviously. Singapore is getting stronger as a fintech center as well. Super apps, as you are all familiar with, continue to grow and buy up competitors. And crypto has surged, and Eddie, I know, will speak about this, and Connor will touch on this as well. And it's the test bed. So the rest of the world will be watching to try and understand where we might take things forward. Latin America, particularly in the small business space, is becoming very, very aggressive. More and more money is going into Latin America from VCs, global VCs. And we can see examples as Brazil's Nubank raising $400 million at a valuation of $35 billion in 2021, has now gone on to expand beyond its home market. And as an exemplar of that chief mindset officer, there is none better than Nubank. Have a look, if you have time, at them as a case study on how they built out that bank, how they use net promoter scores, how they use referral schemes, how they don't see it so much as a bank, but they present it as a brand, and it has captured the imagination of their customer base. So funding is slowing. We have to see where this trend will take us because there will be impact all along the chain. If fewer fintechs can come into the market, what is the implication for the whole of that startup community? Will there be companies that can scale? How will that impact the mid to later stage going to market? And what does that say about the fragility of companies as they go forward? Embedded finance is becoming more and more entrenched in the daily lives of everyone around the world now, but it comes with some regulatory challenges. It comes with some understanding for the consumer. We must educate the consumer as to what they're getting involved in. The amount of data that comes from also using embedded finance, that working with big tech, working with incumbents is key. The data that was previously siloed now can be shared, insights extracted, hyper-personalization will continue, but it will all come to me as the consumer in one place. Lots of competition between big tech, fintech, and incumbents, but I think it's becoming more collaborative. I see regulation as an enabler, but it's definitely going to come, more of the companies are going to come under the scrutiny of the regulators in the years coming forward. DeFi and Web3, again, they'll unlock new avenues, and I will let Connor and Eddie explain that. And we're seeing emerging markets continue to grow, and I think that is a trend that will definitely continue. More money will go into them, more fintechs will come out of them, more collaboration will come out of them, and that will only be hopefully better for the consumer. Thank you very, very much. That's the end of my presentation. And back to Vera.
Thank you very much, Ms. Helen Panzarino, for such an insightful session. Ladies and gentlemen, we would like to invite our second speaker for today's event, Mr. Connor Svensson, LIBF Adjunct Faculty and Speaker, Web3 Labs. Connor Svensson is the author of the best-selling book, The Blockchain Innovators Handbook, and host of the Web3 Innovators podcast. He also writes a weekly newsletter on Web3. He is also a lecturer on the LIBF Certificate in FinTech Practitioner Program. He is the CEO and co-founder of Web3 Labs, which works with organizations to define and execute their Web3 strategy. Connor previously chaired the Standards Working Group at the Enterprise Ethereum Alliance. He is the author of the Blockchain Integration Library Web3J. Ladies and gentlemen, please welcome Mr. Connor Svensson.
Thank you very much for having me, and I'm really looking forward to Thank you very much for having me, and I'm really looking forward to this opportunity to speak with everyone here, and hopefully we'll come away with a much wider appreciation of Web3 and also the metaverse. So let me just share my slide deck there. Hopefully that's all appearing as it should be. Now, just to give you some context here, I'm sure many of you are aware of the Web3 and the metaverse in terms of them being spoken about a lot within sort of popular culture, the media, and so on. And really, what I wanted to do in my presentation today was provide more of a grounding on Web3 and the metaverse, and where there is synergy for the two to sort of interoperate and converge together. These are both very much so emerging technology spheres, and they are going to continue to gather momentum over the following years. But I think it's very important to use as a reference point the sort of the cutting edge of what's happening here, because certainly parts of Web3 have already significantly become a part of the financial ecosystem in certain respects. However, with respect to the metaverse, it's still much more on the fringes. And so the references that I'm giving here are more about where the cutting edge is, because it's where the cutting edge is that we will see the inspiration come from there and permeate through other industries. And so this is really how I'm going about this, and the goal really is that you come away at least with your own opinions on where we are with all of this technology. Okay, so I'm going to start off by talking about Web3, then the metaverse, and then about the convergence of these things. So starting with, I guess, the fundamentals. Starting with the fundamentals here. Let me just, there we go. So I just want to make sure my slides are in sync. If we think about the World Wide Web, I'm sure you've all heard the word Web3 being thrown around, but I think it's very important to provide some context and some definitions about really what Web3 is, where it came from, so that it's not just this abstract term, but it is something that you can really get behind and understand the differences between these different iterations of the web. And so as per the table here, this is really the third generation of the web. But really, when we think about the World Wide Web, or the web, it really emerged in the early 90s, and it was built on top of the internet. The internet was originally a private network, initially created by ARPA, which was in effect the defense part of the US, but then it's tied up with academic institutions. And this was a network that sort of evolved over a number of decades before it actually got widespread traction in the 90s. And the key enabler there was that common standards were created for the representation of data and how you consume this data and how you access this data. So for those of you who were using the internet in the 90s, I certainly count myself in that camp, and I'm sure some of the other people who are here today do as well. But it was really about serving up static content. You could create a website with any information that you wanted to. That was written using HTML, which was a universal markup language. You could consume the information using a web browser, and you could access this information by typing in a URL, which in effect is a human readable string to access something that's on the internet. And the key components of this first iteration of the web was that it democratized access to information. All of a sudden, anyone with an internet connection could actually create a website and they could host it up, and then people could consume the information that was there. And so this was really the key innovation. And you had, at that time, the significant companies that came along were the likes of Yahoo, Alta Vista, these sorts of companies that were indexing or trying to make sense of all of this information and bring it into one place. Because that was one of the complexities, was that anyone could create a website, but then it wasn't easy for people to be able to find it. But if we think about the overall theme there, it was this idea of being able to consume and read data from the World Wide Web. And that really typifies what Web 1 was all about. Now, I would argue it wasn't until Web 2, which is really the phase from 1999 onwards, that the internet and the web started to get a lot more mainstream traction. There were a lot of technical barriers to entry with using the earlier web, in that you had to understand how to write this HTML markup language, which, whilst wasn't as complex as writing computer code, it still was non-trivial. It wasn't as easy as using a word processor to write a document, for instance. And also then, in terms of hosting that data, you tended to need to have some technical expertise to figure out how to put this website somewhere that it could actually be served up. And so the Web 2 really challenged that, and it started to innovate significantly by providing these services, which not only made it possible to publish data through the likes of blogging platforms, for instance, but also write data to it as well. So you had this sort of interactivity, which enabled you to not only make information available, but create services where people could write to those to publish information as well. And so this is really the key idea of what created this Web 2 revolution. Now, another very important part of this was the idea of social networks, because this ability to read and write data to these websites enabled a whole host of new interactive functionality to emerge. And there is probably no greater example than the emergence of the social networks we saw at this time, Facebook, of course, being the most prominent one, which today has billions of users. Now, I'm sure many, again, those of you who have been in the technology field for a number of decades, you will remember those early days of Facebook, where what was so powerful about these social media platforms, it wasn't like they are now. It was very much so, all of a sudden, with a platform like Facebook, you could connect with all of your friends, and you had a way to stay in touch with all of these people, which was really exciting back then. Also then, with platforms such as Twitter, you were able to hear from thought leaders or people that you really respected. Whilst there was ways of having dialogue with them, it was more about being able to get information or thoughts directly from these people you really admired or looked up to. And so that was very significant. LinkedIn, of course, provided a mechanism to keep in touch with all of your professional connections. Now, the field of social media has evolved, and it's had a lot of criticism in the last few years, especially with these views of data being harvested, fake news, and these sorts of narratives. But I think if we, rather than getting into the details of that, I think the important thing to note here is that Web 2 was this idea of being able to read and write data, creation of interactive services, publishing platforms such as originally Blogger, but then Medium, and then the social media. Now, the Web 3 iteration of the web really commenced in 2008 with the emergence of the Bitcoin network. The Bitcoin network was a very significant innovation because what it did was it provided a digital currency that could be used as a way of transacting with another organization or person without having to go through an intermediary. In effect, this network that resided on the internet provided the trust that an intermediary would have historically in order to facilitate the transfer of funds or a payment or whatever else. And this was very, very powerful and revolutionary idea, and it was pioneered by the Bitcoin network. Prior to the Bitcoin network, it was not possible to transact with another intermediary that you didn't know or trust without going through that intermediary. And so this was the major innovation, and behind that you had the blockchain. That was the technology specifically within Bitcoin that made this possible. And so this idea of having these digital currencies is very much a key idea behind Web3. And so whilst Web3, the genesis really was with the Bitcoin network and the distributed ledger or blockchain, that was the foundation upon which an entire ecosystem has evolved in the subsequent years. And so that's what I'm going to just touch on briefly here. I know that Eddie's going to be talking in depth about NFTs as well after this. And so he's going to be going a lot deeper into this than I am. But really what I want to make everyone aware of is some of these emerging themes, not only about where we are now, but what are some of the ones in the future to be aware of. Just sorry, one quick point on the. I see that there are some questions popping up as well. I'll continue to talk through, and then I can either answer them offline, during the subsequent sessions, or I can make time at the end. If someone possibly can just advise me in terms of which way is the best way to go with it, but I'll happy to make time to answer that. Okay, so moving on, if we think about Web3 right now, as in where we are in 2022, there's a number of key themes that have emerged around it. The first of these is cryptocurrencies. And so cryptocurrencies like Bitcoin, Ethereum is another major one, which I'm sure you've heard of. Today's been a very significant day in the news because of something called the merge has successfully happened in Ethereum, which I encourage you to well, I'm sure will bubble up onto your radar. That took place less than an hour ago, so it's a very significant milestone in the world of cryptocurrencies today. But this is all underpinned by blockchain technology, and then you've had these ecosystems that have emerged on top of these Web3 technologies. So these include DeFi or decentralized finance, NFTs, as mentioned earlier, and the metaverse as well. And part of this sort of mainstream awareness has come from certain projects that have gained a lot of gained a lot of attention. So on the cryptocurrency side, you've got Bitcoin and Ethereum, but also you have these other projects that the likes of Elon Musk have spoken about called Dogecoin, which is this dog that you see there. But within the world of DeFi, you have innovations such as stable coins, such as the USDC stablecoin, decentralized exchanges. Then in the world of NFTs, you have this project called Bored Ape Yacht Club, which has been an incredibly successful vehicle for speculation, really, but it's demonstrated how much interest there is in this. And then finally, Facebook rebranding to Metaverse at the end of last year as well. That was really started to bubble up this whole Metaverse narrative into a much wider sort of public consciousness. There's a lot of information, though, about all of these. And as Eddie's going to be doing the deep dive into the NFTs, really what I wanted to talk about was the broader theme, though, of where I think two very important themes that Web3 facilitates, which I believe are going to be very transformative in terms of their wider impact within really all industries, but definitely banking. And so this is this idea of tokenization and self-sovereign identity. Now, I'm going to talk briefly about each of these and just give you a little bit of context on them. So here we have a tweet from someone called Chris Dixon. Now, Chris Dixon is a very well-established figure in the technology scene. He's one of the general partners at Andreessen Horowitz, arguably the best-known Silicon Valley venture capital firm. And he put out this tweet last year, which I think really summed up what is the power of Web3 technology. And this to me is really helps frame the thinking about how disruptive it will be. And this is the notion that tokens are a new digital primitive analogous to the website. Now, if we think back to when I was talking about Web 1, the primitive, or this key sort of cornerstone upon which everything was built, was actually the website. In terms of all of a sudden anyone could create a website. There were initially thousands, then millions, then billions of websites being made available. Google found ways to index all of the information there and make it available to people in a much more consumable format, which brought huge adoption of the web. All of these different online social media platforms were built using website technology. And so when you think about it in those terms, you're very aware of how impactful the website has been in terms of within society. Every single corporate now has a website. It's a key part of any digital strategy for an organization. Yes, it has evolved in terms of you now have really two segments, in that you have the app-focused web applications, as in that people access on their smartphones, as well as the traditional website that's on via a computer. But the point is it's been a mass. It's had a mass disruptive effect on society and business as a whole, because everyone is online now. Everyone consumes information from websites. And this really is the view about tokens within the context of Web3, in that tokens are this primitive that's like the website. And I think it's fairly simple to illustrate how there are similarities here. Blockchain technology enables anyone to create a token in the same way that anyone could create a website if they had internet connectivity. And if you think about it in those terms, that the same sort of low barriers to entry, but at this point, like in the early days of the web, it still requires some technical know-how in order to do it. It's not very dissimilar from how the web was in its early days in those regards, because it wasn't easy to publish a website. And that's exactly where we are right now with tokens in Web3. But the point with tokens is that right now we're in this kind of, really, it's been driven by speculation, the phase. These tokens can be cryptocurrencies themselves, or they can be NFTs, and they can be used in various applications. But really, when I say the words cryptocurrency or NFTs, I'm sure that many people here think in terms of these assets that people have been speculating very heavily on, trying to see a really good return on them, and less so on the more impactful use cases. That's not to say there aren't many people and organizations focused on the very impactful ones. There absolutely are. And certainly within the context of central bank digital currencies and in the wholesale finance markets, there's a lot of momentum behind using these tokens with distributed ledger technology in order to actually tokenize cash flows, say, between different financial institutions within the wholesale market. Instead of having assets instead of having transactions being maintained by a tight-knit group of regulated entities, you can create a tight-knit blockchain or DLT network for these regulated entities to actually all connect into, and that can represent the actual transfer of currencies between those organizations. And so this is where, when you have central banks in the mix for central bank digital currencies, and just these sort of payments taking place between these entities, there's tremendous opportunity there, and that's just one specific area of it. But really, to talk sort of to this broader narrative, so there are these areas that are finance specific, but also I think the important takeaway here is to think that these tokens can represent any digital or physical, any real world physical or digital asset. So a token could represent the deeds to a property. It could represent a financing agreement that a person has taken out with whether it's the finance arm of an automotive company or a bank. There's so much there. In effect, anything that exists on a balance sheet that you can represent as that right now likely exists as some sort of document or digital document, can be represented in a tokenized form. And what's so powerful about this tokenized form is that it enables you to have a standardized way of representing it that can transcend the boundaries of an organization. So in the same way that if you think again about the website analogy, a website is a standardized way of representing information. A token is a standardized way of representing an asset that is that is internet scale rather than being defined within the confines of a specific organization. And this is what makes it such a powerful concept. Now, I think for anyone listening, it's very important to think about this mass tokenization, because this will happen in my view. I firmly stand by the beliefs here, but it's more about when, because certainly they do have an identity problem right now in this world because of the speculation associated with cryptocurrencies and NFTs. But the bigger picture is so much bigger than that. And the speculation narrative long term will be a very small part of the broader market here. Some of the other areas with respect to tokenization, and I think this, the first one, the digital twins as they're called, where they represent some real world or digital asset, is very key. But you can also use them for sort of membership or loyalty programs, which again, I'm sure Eddie will be mentioning in the context of NFTs. Also for governance as well. When you have these decentralized networks, you need to have some sort of governance built into them, and tokens can help with that. And then gaming too. Now, I am going to talk a bit more about gaming in subsequent parts of this, because really, and I'll explain exactly why, but within the metaverse, that's where the most activity is happening right now. So I think it's very important to understand, where the cutting edge is here in this respect. Okay, so that's the other important topic that I wanted to discuss was self-sovereign or decentralized identity. And this, there are certainly some parallels with what's discussed in the context of NFTs as well, but they are slightly different. And this is something that doesn't tend to get as much airtime as the tokens or some of the other areas of Web3, but from a corporate perspective, it's such a big opportunity, which I think it's incredibly important to highlight this. So this idea with identities right now online, typically they exist in a few different ways. So for instance, if you bank online, or maybe you have a share dealing account with a broker, or perhaps it's just on an internal system, you have some sort of centralized system that provides that provides the identity and access control to that system. And one of the big challenges with this is that these systems go down. I'm sure many people here have experienced some sort of outage, be this within a professional or a just in a leisure setting, where where a service that they rely on has not been available, so they've been unable to identify or authenticate themselves against the service. And so this idea of decentralized or self-sovereign identities turns this on its head, and it actually removes these silos of that provide authority and identity to users, and actually puts the credentials in the hands of the end user. And so exactly how this happens is something I'm going to touch this on the surface of. But the idea is that organizations, rather than being in the business of having their own walled gardens of where, say for a bank, you go through a KYC process to identify yourself as a customer, then you go to another bank and you go through the same KYC process again to identify yourself as a customer. Both banks build up exactly the same data set. There might be some human error involved in the mix, so those data sets slightly converge end up slightly disjointed from one another. But the point is that there's right now in within different businesses, you have the same customer data being replicated again and again and again. And in terms of the online experience as well, if you think about when you sign up to an online service, you use a username and password. It's exactly the same thing, where you have the same data being shared constantly. And so what these self-sovereign identities do is they change this. And so instead of I think a bank example is a good one. Instead of having your own walled garden where you you have this information about the customer, but it doesn't go anywhere else. What you do is when a customer has onboarded with you, you issue a what's called a verified credential, which is a fact about that customer, and that fact lives in a wallet or a digital wallet that the customer owns. And so what that means is that the customer can take this wherever they want, and they can use it to you as in effect an attestation to say that they are a customer of that bank. And then so if you onboard with one specific bank and you go through the KYC process, they issue this credential, then you can go to another bank and say, hey, well, I've already gone through the KYC process with this bank. Here's the proof of it. It's all, and then it's verified cryptographically against the issuing organization or issuing bank in this example. And that's information doesn't then need to be duplicated. You are in control as the end customer of who you disclose this information to, but the bank is in the business all of a sudden of issuing facts or credentials about these individuals. And so what it actually facilitates is entirely new business models for organizations. Any organization which has a very large customer base is in a great position in order to really embrace this technology and create new products and services for it. If you have tens of thousands or even millions of customers as an organization, you could provide a service for your customers to issue these digital facts about those customers and then charge a fee to, in effect, allow other organizations to verify with you that the information you stated about the customer is accurate. So it's an incredibly powerful piece of technology, and one that, again, alongside tokenization, is very much so a part of the Web3 landscape. Because of this idea of it's underpinned by cryptographic technology. It is important to say that this is not a NFT or token. Whilst there are some similarities, what you're doing here is issuing facts about an individual or an organization. It could reside on a blockchain, but it doesn't have to. But the point is they're not transferable. Like, say, if you're a passport issuing office or a driving license issuing office, you can issue this fact, which is a driving license or a passport about someone, but do it in a digital way. And then anyone who reviews that digital document can see that the organization that issued it via their cryptographic key was genuinely the one that did it. So again, it's another incredibly powerful area for this. Now, I'm just having a quick look in terms of just the questions that have popped up as well, because I know there's been a few. No. What I'll do, I'll just as I finish up this section on Web3, I'll go through the questions as well. So the other key thing, though, to say just about Web3 is that there are still challenges here. So user experience is a big one. For anyone who's actually worked with transferring a cryptocurrency, buying an NFT or embracing DeFi, or even just purchasing cryptocurrency in one place, sending it to another, it's a clunky experience. It still has a way to go. You end users are exposed to quite technical information, such as these long hexadecimal strings, which is not ideal. And so this is one area in which it still needs to evolve. And then the security as well. If you're following the news, you will be aware of these high-profile hacks and thefts that take place. Part of this, I see it as helping the ecosystem mature, but at the same time, we're still very much so in those Wild West days with it. So the overall point, though, I want to really drive home about Web3, though, is that there's a lot more to it than what people talk about in terms of in the public consciousness. You know, when you see Elon Musk saying things like this about Dogecoin, and you see these Bored Ape Yacht Club NFT avatars, which people like, Serena Williams, the tennis player, Eminem, the rapper, Jimmy Fallon, the talk show host in America. These are all prominent owners, but that's one part of the narrative. But the bigger themes and what's possible with this are far bigger than what's currently in the sort of popular consciousness there. So just to quickly go through a few of the questions, I'm going to answer fairly briefly here, just because I want to ensure, of course, that people come away with answers, but we're not spending too much time on them. Okay. So this is a question: will cryptocurrencies take over the dominance of financial transactions, whether top companies start to invest in them, and why is the regulation of the world central banks so resistant to crypto? So I think long term, whilst it won't be cryptocurrencies themselves, I do believe that cryptocurrencies will emerge. Some of them will be considered what I call non-sovereign currencies in the long term, which is where they're treated in a similar way to the fiat currencies we have right now, but they're not tied to a sovereignty. But it's more about the technology. I think that all central banks, regulators, they're all very aware of how powerful this is, but they'll want to do it in a way that remains regulatory compliant. And so the central banks aren't resistant to it. It's just that you have highly regulated markets. You need to ensure that the end users are protected. And the last thing you want is to be pushing people onto these public networks that are still relatively young in terms of their overall maturity there. So it's like I said, I do believe that cryptocurrencies will move. Some of them will be taken seriously like currencies long term, but they need to lose the price volatility. But I think there'll be a remaining feature there. But the regulation, it's incredibly complex. So now there's a question. Let's see. I'm just seeing that some of these questions are not related to the crypto side of it. Okay, so another one, should the financial industry accept cryptocurrencies as one of the payment mechanisms in the future, despite of that high risks based on speculation? What is the mitigation that the financial industry should adopt to ensure the fluctuation won't destroy the businesses and have domino effects? Again, this comes back to, I think, the other point. While long term, we need to have price stability on these cryptocurrencies for them to be currencies, right? Whilst they're called cryptocurrencies, they're not really currencies right now because of the volatility of them. And this is where, as I say, this idea of non-sovereign currencies, which kind of are those that are almost recognized by regulators as being legitimate currencies, not tied to a sovereignty, will be where that emerges from. It could still be years off, though, but that's where I think we will end up. And so, really, it's going to be important that people, this stuff is given time to play out and start to become more stable assets. But we do also have stable coin technology now as well, which is where you have what is in effect defined in a similar way to a cryptocurrency, but its price is dictated by a stable asset. Now, the really, really important thing when we talk about stable coins is that you need to have fully collateralized stable coins, as in if you have a version of a dollar that resides on a blockchain, you need to ensure that you have all of the collateral to back all of that up. Circle is probably the most prominent voice in this domain in terms of they make use of the auditor's grant thornton to really provide as much transparency as possible in their asset reserves there. But that's really the key thing to ensure that you have this price stability, that anyone who's creating these stable assets needs to ensure they're de-risked as much as possible there. And that's right now, it's about fully collateralizing this. Anyone who's heard about the Luna cryptocurrency that failed a few months ago, that was not fully collateralized. It was collateralized in a somewhat what they thought is innovative way, but ultimately was backed by a very price volatile cryptocurrency rather than US dollars, for instance. And so that was, had a huge problem caused a huge problem, when it unwound. Okay, with the relative ease of creating cryptocurrencies and blockchain and its speculative nature, how do you propose the incorporation of cryptos into the banking and well-established financial institution in a sustainable way? Again, this is it's kind of taking the baby steps here. It's ensuring that you start by you want to start off by creating perhaps a closed blockchain network where you know who the participants are, so that you have that control there. I think ultimately to ensure that these things can't run away, you need to in regulated industries, you need to have controls in place there. That not only protects the access to the network, but also the assets that are being defined there only have their value as far as the participants are concerned, rather than being priced having value outside of that network, because that's when things can become the target of hackers and so on. Long term, I think that public networks will be much more widely embraced, but in the nearer term, I think the best place to focus is on smaller closed networks, just until the organizations have that sort of level of understanding and maturity with the technology. Another question, security. How come they read about these crypto exchanges being hijacked or hacked? How can we ensure that tokens remain secure? Is it enough to use some of the established mechanisms for this? What I would say, because it's a young space, it's evolving. It's this whole thing of it's the Wild West right now with these public cryptocurrencies, whereby people are, to a point, experimenting with new products or services. Some of those are being hacked, but I think what will happen long term is we'll have these base components which have really stood the test of time and are considered to be rock solid. With all of these public utilities, the longer they run, the more users they have without issue, then the more resilient they are. And so it's more about maturity of the space for that. And so I think the best answer is you've just got to give it time and let this sort of stuff, the technology mature, because we will solve these problems, but not all of them are solved just yet. Right, another question, how will Web3 manage big data efficiently with AI, machine learning and blockchain to manage data on the web? Indonesia is currently still focused on maturation and completion of digital transformation. In your opinion, how long do you think our country can take advantage of how do you think our country can take advantage of the Web3 platform in the next level of the financial industry, given the adequacy of infrastructure and government regulatory support? And so I think it's important to separate Web3 from big data and AI and machine learning. Whilst there is overlap, they're not all tied to one another, so they're kind of different themes there. I think there's multiple ways in which the different countries can embrace the technology. I think one part of it is it's being sensible with the regulations. Now, I'm not certainly Indonesian regulation with respect to cryptocurrencies is not an area that I have any expertise in. And so my examples, I suppose, would come from the UK where I am. But certain things like ensuring that there's clear guidance from a tax perspective is a good starting point for to ensure that people know how to treat them, but also that you have central banks and financial organizations thinking about opportunities for closed networks as well, that they can ring fence will help with the overall adoption there. With respect to these public networks, I think it's better to play it safe. Ultimately, you've really got to continue to protect consumers there. And whilst outlawing them I think that's a very strong thing for, if a country chooses to do that. I do think it's important that you have controls in place there to ensure that people can't be targeted by scammers, and that there's ways in which organizations are prevented from just being able to launch a cryptocurrency arbitrarily there. So whilst it's not a very complete answer, I hope it gives some perspectives. Right, I've got another. Okay, so a question on decentralized identity. How can you ensure someone doesn't have more than one digital identity? You can't, and you don't need to have to. The good thing about digital identities is you can create new ones. So if you want to go through separate KYC processes with separate organizations, then that's certainly feasible. However, ultimately the point with this technology is it puts the control into the individual's hands, which is very significant there. Okay, because of the game of commercial business, using IT requires players who understand computer languages. What needs to be done to have reliable regulators to protect consumers when so much of this is driven by deep technology, basically? And I think the answer there is that it's important that regulators, they don't need to be technology driven, but they do need to be paying attention to what's happening within this the Web3 industry more broadly. Scrutinizing at the level of code or smart contracts is something that would be very challenging to do, but I think it's more about understanding the intent of these applications and the purpose in which they're being used for, and that can shed a real light into all of this. Another question about inviting. Why don't you invite us all into the metaverse to meet together to show us how a bank could operate there? So certainly, I would recommend anyone who wants to get a feel for the cutting edge do try out one of the Facebook Oculus devices, because it gives you an idea of what is the cutting edge right now. Okay. So what I might do is, just in the interest of time, I'm going to come back to the questions and keep moving, because I've covered a few off there. I know there will be more, and if I don't get a chance to cover them here, I will look to type them after this session's finished as well. Okay, so moving on to the metaverse. So just in terms of some of the fundamentals here, let's start with the definition. I'm sure many people have heard of the expression, but the point is that according to Wikipedia, which I think is a very good definition, the metaverse is a hypothetical iteration of the internet as a single, universal and immersive virtual world that is facilitated by the use of virtual reality and augmented reality headsets. That's VR and AR. So the metaverse, really, it's emerged, as with a lot of things from certain popular culture, specifically sci-fi. There's been some quite seminal texts that were written in the past few decades, which helped popularize some of the ideas here. It started off, though, in 1984 with the author William Gibson, who published his Neuromancer novel, which really described a virtual reality data space he referred to as the Matrix, which was no doubt a significant inspiration for the film by the same name in the 90s, starring Keanu Reeves. But it's one of the earliest and best known books of what was called the cyberpunk genre, and where you had a protagonist who was hacking a simulated reality in a cyberspace that was defined in the book as well. And funnily, the term cyberspace, I'm sure you've all heard it used to describe the World Wide Web. That was lifted from this book and sort of helped popularize by it. So whilst this was talking about more of a virtual reality connected space, this idea of cyberspace was still pulled in for this idea of the first iteration of the internet. In 1992, the sci-fi author Neil Stephenson, he published Snow Crash, and this was where the term the metaverse came from. It was a term that Stephenson coined, talking about a successor to the internet, and it was based on this idea of how a virtual reality internet might evolve in the future. It resembled a massively multiplayer online game, and people had their own avatars in it, and it really sort of connected all of the citizens of the world globally via this digital platform that was owned by a large corporate in this world. And then more recently, in 2011, you had Ready Player One, which was set in a dystopian 2045, which followed a protagonist who was playing, in effect, a virtual reality game, the discovery of which would enable them to inherit the game's fortune. And so these are some of the very prominent examples of the metaverse in popular culture, and they're all very good books as well, if you do want to pick them up and have a read. But I think what they did, and they really set the scene for something ahead of it sort of arriving. And this is always what's fascinating about sci-fi as a genre, in that the ability of some authors to prophesize the future to a point. Of course, they don't get it perfectly right, but some of the ideas there, it's incredible how accurate some of them can be. But when we talk about the metaverse, though, there's kind of like these two components to it, so to speak, around how you access it. AR and VR. AR is augmented reality, so this is where you have your, in effect, generally it's considered to be a set of glasses that you wear, and they augment your surroundings to provide digital information on top of what you can see. So on the left here, we have the Pokemon Go game, which came out a few years ago, which augments these Pokemon characters onto a phone screen in the surroundings of where you are. The one in the middle there is a new device that's a company have bootstrapped, which in effect allows people to wear these glasses and see avatars of them running previously to compare their current performance against. And then finally, we have the VR, which is where you put on like a very immersive headset, which is really takes in all of the senses. So you have your eyes and your ears, and it's really meant to immerse you in this virtual world, irrespective of your surroundings. Here we have the Web3 Labs metaverse office there, and this was using an Oculus and so some of my staff there, but it just gives you an idea of the differences between these. And then in terms of the devices, really at this point in time, there's probably three main consumer and business focused devices. You have the Oculus Quest 2, which came from Facebook, now of course called Meta. And this is more aimed at more of the consumer market, where it brings people into these virtual worlds. And then Google and Microsoft are working on their respective augmented reality platforms, which are these kind of glasses which project onto them. And they're actually focusing the business markets more there for areas such as training or collaboration between other team members. And their Google Glass and Microsoft HoloLens are the sort of main technologies there. Again, it's still very much so an emerging landscape, but these are, I guess, some of the best known products in the space right now. And then specifically with regards to the metaverse, why is it that it's suddenly become a thing all of a sudden? If we go back 2 years, no one was really talking about the metaverse. It's very much so a theme that's emerged in the last 12 months. And I think one of the pivotal moments was with Facebook in October last year, announcing they were rebranding themselves to Meta. And what they wanted to do, I think part of it was to disassociate them from the name Facebook, which certainly off the back of the fake news scandals and some of the practices there had not been very good for their wider perception as a business. But also they said this notion of really wanting to double down on it. But then in parallel, we had seen some within the Web3 industry, these projects emerging within Web3 that started thinking about this metaverse world. And the reason being is that if you can create assets that can represent a real world asset or purely digital assets, they can have some ownership tied to them. So some smart projects in the Web3 space thought, well, hey, we could actually create virtual worlds where we can sell we can sell plots of land or spaces within these virtual worlds, and the ownership can be tied to a blockchain, which is kind of how the physical world will go long term with respect to the technology. But there was some companies that really had some great foresight there. And then, of course, we can see now with companies like Deloitte and other major consultancy firms really coming from a thought leadership perspective about this idea of the metaverse and Web3 and how they could converge together. I'm going to get into the details of how they could in the next segment, but I think it's important just to highlight this. So, with regards though to the metaverse, whilst there's been all this sort of fuss about it and discussions, there's still a lot of challenges with it to create what is a seamless metaverse. One key idea is that, well, one key point is that whilst in Neil Stephenson's Snow Crash, which I spoke about in some of these other books, you had a sort of a large company that owned the metaverse. It's really crucial that we don't end up in that situation where the metaverse is owned or controlled by a single entity. That would be a massive failure for, well, human civilization, some could argue, because the amount of control that could be exerted there. If you think to a future where, say, a majority of the world's population is in the metaverse, or even just if the metaverse is as ubiquitous as people using their phones, their smartphones is right now, that's a very significant chunk of the world's population. Whilst not half of it, it's still a very large number of people. And so to have that level of control over people would be very bad for it to fall in the hands of one organization. So it's very important that there's widespread interoperability with it as it emerges. But the hardware right now simply is not up to scratch to provide a true sort of seamless experience. If you think about some of the most cutting edge graphics that people see, maybe watching one of the Disney Pixar movies, for instance, such as recent titles, I'm sure they've put out a Toy Story recently or something like that, but you can kind of see what the cutting edge animation looks like with a number of these these kind of rendered films and so on. To have that sort of a visualization, to have that sort of experience in a virtual world requires huge amounts of hardware processing power, because if you've got these goggles on that if you're looking here, the device needs to respond to where you're looking at and render up this image. Then if you turn your head there, it needs to render what you can see there. And so this is has incredibly high computational costs. So to actually create something that looks as real as the real world requires a massive leap in terms of where we are right now from a hardware performance perspective. There's also challenges with internet connectivity. Certainly there's huge portions of the world that do not have really good quality internet connections, and even if those that do, the internet was not optimized for real-time experiences. It was more optimized for the transmission of data between different places in a way where things could be rerouted, and if they came out of order, they'd be reordered. But if you're trying to create a very realistic experience, things like latency and responsiveness are absolutely key, because you can't pull the wool over the eyes of a person's cognitive system. You need to provide a very real feeling experience, or people will not believe that they're there. And so that has some significant challenges. And then there's the overall maturity of Web3 as well, and it is certainly evolving quickly, but at the same time, if you're pinning the metaverse on Web3, that potentially slows things down a bit. So just to finish on the metaverse, it's helpful to look at this Gartner's latest hype cycle. Now, whilst Gartner doesn't always get these things right, and certainly if you look at the hype cycles over time, there's certainly things do move around a bit. But what's interesting about the metaverse on this is that they see it as being in the early days, but also that they're seeing it as being over a 10-year time horizon for it to sort of plateau and fulfill its potential. To give you some context here, I mean, they certainly see Web3 as being, up here in terms of where it's at the peak, and certainly like NFTs in terms of the speculative aspect of them starting to have reached their plateau before they start to go down slightly. And so just gives you a sense of still how early we are with this whole metaverse thing. So I think it's very important to highlight that. Now, in the interest of time, I'm going to continue just going through the presentation to tie it up. But then what I will do is, if we have time, I will continue to answer questions that people have given, because I'm sure that there'll be enough. There's enough of them there to finish up the slot there. Okay, but let's move on to Web3 and the metaverse. And I think one of the things to talk to here, which is very important, is why is gaming such a good example for the metaverse? Why does so much of the talk around metaverse seem to come back to gaming? And the reason why is because gaming is something people do in their leisure time. When people do something in their leisure time, they want it to be fun. They don't want it to be a lot of effort. They want it to be as seamless as possible. Hence, if you can build products that appeal to people in their leisure time, you're building a user experience for that person, which is far superior to something that they'd be willing to put up with during their work time. Certainly when you're working, there's a degree of, you have certain objectives or things you have to get done. You are willing to put up with things potentially not being as smooth as they could be because of that broader working together and that mission of what you wish to accomplish through your work as part of the organization or to the customer you're serving. When it's leisure time, people are trying to relax, and so hence the thinking in terms of optimizing this experience for people in their leisure, that if that is got right, that will be the catalyst which really enables this wider uptake of it. The other side too is that this idea of virtual worlds is something that's been built in video games since their early days. And so you can't really think about these virtual worlds without looking at the video games industry. Hence, I think it's very important to highlight this from the perspective of the gaming industry rather than a different industry such as finance, because these sorts of innovations will trickle down when they're executed well within the gaming industry. So I think it's very important to highlight that point. But why Web3 and the metaverse? So What we have here is just a picture of a game marketplace. This one specifically is from what's called a trading card game called Magic the Gathering. But the point is that they have their own in-game currency for people to buy things. They have their own in-game currency because they want people to spend money. They make the game available for free for people to play, but they want people to spend money in the game in order to generate revenue. And this is something that's been very transformative in the gaming industry in the last 10 years in terms of what's called free to play. Prior to free to play, games always used to cost money. People had to buy a copy of the game, whereas the free to play model turned that on its head, and some bold companies said, hey, we don't need to charge for our game. We'll make it available for free, but what we'll do is we'll provide upgrades that people can choose to purchase that enrich their in-game experience there. And this has exploded as a category, and this is where the biggest revenues are now made in the gaming industry. So it was very much so, I think it's worth highlighting because it was a hugely disruptive way of doing things in gaming, and people certainly thought, no, we need people to pay for games. This will not work, and it's ended up being more profitable for the companies that have executed on it. But in order to purchase these items, many of these games have their own in-game currencies, and part of that is to create these kind of walled ecosystems around them. And also, though, too, it can be because of the high fees that they need to pay to companies like Apple, which is 30% to sell products on their app store. And so there's certainly an appeal there for these games to be able to provide their own payment solutions or own potential in-game currencies as well to pay for these different assets, because they can potentially cut out the likes of Apple if they wanted to with this. The other side, though, is that NFTs, and I no doubt Eddie's going to be unpacking this a lot more, but this idea of NFTs representing in-game assets is very powerful, because if you have a NFT representation of an asset, it's something that someone could potentially take from one game and sell it to another user of that game, or potentially transfer it to another game. There are challenges associated with that, which I'll come on to, but that's kind of the idea. Now, the incredible thing about NFTs is that they can have royalties built into them. So every time they change hands, the original author of it receives a royalty payment. And so there's certainly an argument that's to be said for video games publishing houses that if they can create NFT, there's a nice revenue stream for them.
Sorry, Connor. Remaining time 5 minutes. Okay.
Okay. Thank you. Thank you for the So I won't have time to answer all the questions, but I'll go through them once this session's finished. And so within the Web3 and the Metaverse, we have, there's two main projects. A couple of the well-known projects are Decentraland and the Sandbox. And what they do is they provide virtual worlds where people can buy NFTs that give them ownership of certain things within these. And so if you want to understand a little bit more about the cutting edge, there's these that are good reference points. And likewise, you have these Web3 gaming projects as well. And again, that whilst right now they're not sort of focused, these are less focused on providing a metaverse experience. They do have their sort of virtual worlds and show how this stuff can go. And so Axie Infinity is probably the best known one. People play this game and they actually earn NFT assets, which then they sell. So it's what's called a play to earn game, because people by playing the game actually earn money that they can then actually sell using these digital assets. And this one, Skyweaver, is a collectible card game where people can actually own the assets there. But behind all of these, what you have are these gaming engines, and these gaming engines are going to be an absolute crucial part of the metaverse, because these are what the virtual worlds right now are being built on. The two best known ones are the Unreal Engine and Unity. And what they do is they provide this cross-platform experience. So you can build a game on one of these platforms. Fortnite, which is incredibly well known nowadays, and has a huge player base, which is a free-to-play game. They use the Unreal Engine, and that makes it available on PC. It makes it available on these on an iPhone, on an iPad, on Android devices, different gaming consoles. So you have that universal accessibility, which is something you need with these virtual worlds. And so this is a space where we'll likely see, if these start to embrace Web3 technology, then that will enable Web3 to filter into the gaming industry, and hence as an extension of that, the metaverse. However, there are a few different challenges here. So the first of these is, as I said, that these gaming engines and publishers, they need to embrace Web3 because of all of the speculation with it all right now. They are certainly frowned upon to a point because you have this incredible price volatility. As the price volatility goes away, that will become less of an issue. The other thing, though, is the interoperability side of it. If you have an NFT that represents an in-game asset, I don't know, you have a shirt or a suit you buy your avatar in one game, how can you transfer that to another game? I mean, ultimately, how they're rendered could look very different, and also it would mean that you need a common representation of what a suit looks like in a virtual world there. And then, of course, as well, you have the actual gaming mechanics. You don't want to have a Pokemon card being used in a game of Magic the Gathering, for instance. And so there are some types of interoperability that just simply don't make sense. So there are limitations in terms of what's possible there. And then finally, you do have the performance of these Web3 networks insofar as the user experience is still clunky, but a lot of gaming developers are really starting to streamline that. So again, it's why it's very helpful to see what the gaming studios are doing in this context. But it's certainly the transaction volumes on these public networks are still they're increasing their overall performance over the coming years. So just to kind of sum up the metaverse doesn't strictly need Web3 as such. However, Web3 can certainly provide benefits for the metaverse with people, publishers and so on using it because they have greater access to revenue streams and they're not tied to specific platforms such as Apple in the same way. Web3 is a new technology. It's only been around since 2008 with Bitcoin, and the metaverse with Web3 is an even newer narrative that's only been around for a couple of years. But also for this really to play out, we need to see widespread adoption by gaming engines and major titles there as well. So hopefully that provides some context there. Yeah, and thank you everyone for your time. It's been really good to see the questions. I will sit here spending some time answering them as well during Eddie's session. Okay. How long do I have, just to check? Is it we have another minute or so, or are we at time?
Thank you very much, Mr. Connor Svensson, for such an impressive sessions. And ladies and gentlemen, we would like to invite our third speaker for today's event, Mr. Eduardo Litonjua, LIBF guest speaker, Crypto and Data Science. Eddie leads crypto sales in Vacuum Labs and is passionate about cryptocurrencies and blockchains. He has previously worked in data science, as well as innovation consulting, and holds a BA degree in mathematics from Cambridge and a master's science in computer science from UCL. He has also started a play to earn gaming guild focused around XT Infinity back in 2021, and also works as a venture development lead for a venture studio, Kaya Ventures, based in the Philippines, where he is launching a stealth wallet analytics startup. Ladies and gentlemen, please welcome Mr. Eduardo Litonjua.
Thank you very much. Hold on. Can you guys hear me? Yep.
I can see.
Yes.
Great. Let me just present my So good afternoon, everyone. I hope everyone's doing well. We're at the tail end of the presentation, so I'll try my best to keep things entertaining. So Helena and Connor have mentioned broad themes about, banking, fintech, the metaverse. So what I want to do is like add a few more concrete examples, like starting off with firstly, like NFTs, the different stories and case studies, the definitions, pros and cons, and then going more into like the marketplace side. And that leads more into DeFi, NFTs, and smart contract applications. And that's bridges us closer to like what where there's like a intermingling with traditional finance. And I'll cap it off with what it means for traditional finance. So looking at just let's step back first to 2014. So this was the first NFT ever made, and this was subsequently it was in Sotheby's, and the bidding started at 100, and then later subsequently sold for $1.47 million, right? And here in more recent times, this piece, it was sold for 63.9 million by Beeple. It's called Every Days. And it's his first 5,000 days. It's made up of a mosaic of the first 5,000 vectors and images and GIFs. But it's not just art, but also like in music. We see Grimes, who made 6 million from NFTs by selling images and videos set to her music. So zooming out a bit, we can actually see that a lot of like the innovation and is actually happening more in the artists and the music space for NFTs. And Steve Aoki himself, he made more with one NFT drop than his 10 years in music. So Steve Aoki is a famous DJ in America. He's released like 6 or so albums, but he made more money with NFTs in one drop last year. Right. So it's a little bit what we see here is that a lot of like the a lot more of the influence, like, and it's focused more on the music and art industry, where we see a lot of the gains that are being made. Right. So first, let's go to the definitions, pros and cons. So what exactly are NFTs and why are they so valuable? NFTs are defined as a non-fungible token. And fungibility itself is the concept of something being divisible. So money or Bitcoin is fungible because we can trade one for one, right? So we could have like logs of wood, we could have like points earned as well. Then you have what's known as semi-fungible items. You have shirts, you also have like movie tickets. This is because there's a difference in value between each of these. So when you have movie tickets, you might have a movie ticket that's actually closer to the screen. So that would be valued slightly higher. Or, for example, your favorite color might be pink instead of green. So therefore, you put more of a premium on the color of the shirt, even though they might be the same model and the same type, right? Non-fungible is something that's entirely different, where you really can't distinguish. So for example, if you have a Monet and the Mona Lisa, those are two very, very different pieces of art, and they cannot be valued the same because they're fundamentally like quite different. And this is what the concept of fungibility really is. So it takes that idea of like cryptocurrency and kind of extends it to like these things which can be individualized. And we can see that this is why exactly a lot of like the innovations are happening more in the art and music space, right? So looking at some of what are the benefits that NFTs can provide. These NFTs can provide ownership, which is enforced by a blockchain. So for example, when you purchase an NFT on a marketplace like OpenSea, you can prove that you verifiably own the piece of art on the blockchain. What's also interesting is that NFTs also provide new angles for artists and corporates to monetize. So UNICEF itself is using funds from an NFT to basically create an initiative to connect every school in the world using like low Earth orbit satellites and machine learning. So what's really interesting about this is that NFTs can be used to rally people to a specific cause. So for example, if I'm a big supporter, of supporting like kids in Africa, and I buy this NFT, linking to that idea of the decentralized identity, if that is on my wallet, then I can verifiably prove that I'm actually supporting this cause. So we're seeing that a lot of like the big corporates using NFTs to actually signal what they value and rallying people around that. NFTs can also be fractionalized to improve access. So one of like the really interesting applications in terms of finance is Bacon Coin. So what these guys are doing is fractionalizing US real estate by providing accessibility and turning a physical asset or a home into an NFT. One of the reasons why this is interesting is that in a lot of countries, the prices of real estate are going super, super high because of inflation, right? So a lot of families can now no longer afford these. And if you want a real estate as some sort of like investment vehicle, instead of like buying like the actual asset itself, you could buy a fractionalized NFT, for example. So this would have like a much smaller face value than the real estate itself, but would allow you to partake in the yield that this asset brings. And this is something really interesting because essentially, if you own this NFT, you can earn that rental income regardless of where you are, and you can use the blockchain to distribute that. And this idea is not just happening in the US, but also in the Philippines, where I'm from. There's a project called Commonwealth as well that is doing this here in the Philippines. So this is really interesting because NFTs can actually turn very illiquid assets like real estate and make them become more liquid, right? So this improves like market accessibility. So it's really interesting as well because my brother, he's working in a company called Figure, where they're putting loans and blockchains, the US mortgaging process onto the blockchain. So they're essentially trying to reduce it from 1 month to like 1 or 2 days using like the blockchain, right? So there's many different applications, but this is like one of like the really interesting ones. NFT owners, interestingly, can also own the IP and rights to their own NFT. Connor spoke previously about Bored Ape Yacht Club. And what's really interesting about Bored Ape Yacht Club is that these NFT owners actually have the IP and rights to their own NFT. So they can, for example, there's a movie trilogy that is being made, and Bored Ape Yacht Club owners can like basically put their NFTs up for some sort of auction, and they can earn 10,000 in licensing fees paid in Bitcoin or ApeCoin, which is their kind of metaverse token, right? So this is interesting because it brings about the utility aspect. These NFTs, they're slightly different from art pieces in of themselves because they also have this element of utility. I can actually earn money from my NFT, not just have it in the back of my house collecting dust, right? And this is a digital native representation. So I think this is one of the attractive parts about NFTs and why earlier in my presentation, we saw these like pieces of NFTs being sold for very, very exorbitant amounts. What's also interesting here is that it allows and enables entirely new business models. So for example, royalties can be built in to empower artists. These NFTs allow artists to essentially gain passive income whenever their artwork sells on a blockchain, and it's enforced via smart contract, which we'll talk about later. And it's an immutable piece of code that lives on the blockchain, enables really trustless interactions between different third parties. So as an example, if I was like an artist and my market was Connor and Helene, if I sell my art to Connor, I would receive like a small commission. But if he sells it to Helene at 10 times the amount, I can still get 2 or 3% of that as a sale, right, as a commission. And this can be basically like enforced on the blockchain. And this basically provides like artists a completely new way of livelihood, right? And this was not possible before because in traditional art markets, you have a lot of opacity and a lot of stuff is dealt with over the counter, which means you're not even aware if some transactions are happening. But on the blockchain, since everything is public and transparent, you can actually provide credit to the creator via this royalty, right? So this is why a lot of like artists and musicians are really like flocking to these NFTs because it's not just like a hip and cool thing, but it's also a way to like earn themselves like a different kind of income. However, like we also like want to look at the con side of things. They're also like vehicles for like money laundering, right? So Elliptic, which is a crypto research firm, has identified over 8 million in laundered funds through NFTs. And they use services like Tornado Cash, which we'll talk about later, right? So this still pales in comparison to the 328 million. But the way that they usually do it is that they have like illegal funds and then they buy an NFT to kind of clean those funds, right? So NFT theft cannot be protected as there is no regulations. I saw like in the Q&A earlier, there were a few people talking about like regulations and how can we regulate this space. And the reality is like blockchain is a permissionless and like kind of open ecosystem. So there's no real law enforcement. So one really interesting case study here is a movie star, Seth Green. He actually owns a Bored Ape NFT, and he was creating this Bored Ape NFT movie, but it subsequently got stolen, right? So now what's going to happen to the rights of his movie? If he releases the movie, then all the profits and would go towards the hacker, right? And this kind of like illustrates the problem within cryptocurrencies and blockchains right now, which is the lack of regulation. And there isn't an answer right now, but this kind of like illustrates like the fact that even if it's like no matter what, you can't really get the NFT back, because you can't even identify who the hacker was based on his Ethereum address, right? So that's one of the things. NFT prices are also very volatile, even for blue chips. So blue chips and NFTs, the top one right now is Bored Apes. It almost saw a 70% decline in USD value from its peak USD value, right? I think it was around 350,000, and now it's down to like around about 100,000 USD. They're also priced in Ethereum, which adds even more volatility. So comparing this to like the traditional art asset class, it's probably much more volatile, right? Because it's a much newer and fresher market. But now like sort of let's go more into like the marketplaces, right? Why specifically are NFT marketplaces needed? Number one, we really need price discovery for specific NFT collections. We need a place to actually aggregate buyers and sellers. And there's no physical venues to actually sell NFTs. NFTs like are a purely digital product that lives on the blockchain. And sometimes you can get physical representations of the NFTs, such as like an artwork or a shirt, but that's not really like the original, right? Exchange is also made much more simply in a marketplace versus like a peer-to-peer way, right? And the thing is, counterparties also don't need to trust each other to use an NFT marketplace. So going like back like NFT to December 2017, OpenSea was one of the first NFT exchanges. So these guys are actually a peer-to-peer exchange, which enables users to buy and sell NFTs. And they take a service fee of 2.5% for facilitating the trade. And right now they're one of the biggest marketplaces. They're onboarding like even more chains. I think they have Ethereum, Solana as well. And they take this 2.5% fee. But there's more like innovation. LooksRare innovated on the OpenSea model by introducing this token called Looks, which basically paid out users for the platform, right? Whenever they made a transaction on the platform, right? This actually caused a surge in trading volume, which allowed them to basically provide that 2% reduced fee. And they saw almost double the transaction volume of OpenSea. The problem with this was that there was also like a lot of wash trading, where people would just trade NFTs between their own accounts and accumulate these like Looks tokens, right? So right now, like we're seeing like tokenomics being added onto the traditional exchange model, right? So this is basically the V1 OpenSea, V2 LooksRare, and V3 going like a bit deeper is SudoSwap. So this is the new exchange that actually uses smart contracts instead of a peer-to-peer model. So this use of smart contracts enables like a really low 0.5% trading fee, and it makes discovery easier because it uses basically a liquidity pool. This also allows like new features such as floor sweeping, where if, for example, you're a collector, the NFT price floor is basically like the worst NFT. What is like the value of that? So essentially, like you could like buy like 30 Bored Apes within a single click, right? If you wanted to like do collection. So what's really interesting about this is that we're seeing a financialization of art, like a financialization of like this, like art as like a trading asset, right? And this is really enabled by crypto technologies. So we first saw, for example, like the Bored Apes as just like profile pictures, and then now like you can actually like earn money by putting them into a movie trilogy, and now like you can actually buy them like they're like stocks, right? And this is really possible thanks to these like smart contracts, which is something that we'll get into. So now moving on to like this part of the presentation, DeFi, NFTs, and smart contract applications. So the main difference between decentralized versus centralized finance is essentially the bank acting as an intermediary. So within traditional finance, you usually have a trusted middleman, which is a bank. So for example, if I was to do business with Helene 100 years ago and I didn't know her, like I wouldn't just like give her the money and wait for like a couple of days till she gives me the product. I would give my money to the bank, would then hold my money, and then Helene would give the product to the bank. And then once the bank has both items, I would get the product and she would get the money. And the reason why this happened was because of a lack of trust between Helene and I. So what the innovation that smart contracts have is essentially they replace that bank with like a piece of code, right? So instead of like interacting with a bank, I instead interact with a piece of code where I can basically shoot my let's say like Ethereum into like that smart contract, and then it has to check whether or not Helene has actually submitted her NFT in order for the exchange to happen. And this allows like the fees to be more transparent and much lower because the operational processes are typically like and overheads are typically much lower for this. So this is like the key primitive which is used for building like these new sorts of applications, right? And this is really like what differentiates decentralized finance from centralized finance, where instead of like having like trusted middlemen and third parties, you actually remove that idea of trust and replace it with computer code, right? And this allows things to be like much more scalable, much more secure, much more tamper-proof as well, because code is, cannot be corrupted, right? So the first innovation that came out of this is called Uniswap. And this is really like, this is what's called a decentralized exchange. And this was the first automated market maker to really make smart contracts mainstream. So the traditional analogy is like looking at the traditional order book model where you have like stocks and bonds and you have like an order book which basically matches bids and offers. And when that happens, when there's like a touch, a trade happens. Whereas here, you instead have a liquidity pool of tokens. And essentially like you can trade in and out of this liquidity pool, right? And typically you could have like much lower fees, like for example 0.3% for Uniswap. Also like looking into the other kind of applications of that smart contracts enable, there's a project called Music DAO, and this basically allows artists to unlock future yield of their streaming income via NFTs. So how essentially this works is that streaming income is usually guaranteed by digital service providers such as YouTube and Spotify. So if I'm an artist, I can say I have like 10,000 listens a month on YouTube and Spotify, and that means I can earn like X% X amount of like dollars per month from this. So essentially, like they can then assign an NFT bond which is sold to the public markets, and the artists can then pay off these bonds by a real yield from their streaming income. So essentially, it allows like music owners to like borrow against something that is not possible, like streaming income, and this is secured via like YouTube and Spotify. So these are like one of like the ways and models that smart contracts can actually like impact these kinds of like groups like artists and musicians. Another one is also how bringing transparency to carbon credit markets. So there's a project called KlimaDAO, and these are actually bringing carbon credits and carbon assets offsets on chain. So traditionally, these carbon credit markets are very fragmented, and KlimaDAO is solving this by bridging this on chain, creating this token called BCT. That's basically compatible with like other carbon tokens, right? So it provides a transparent marketplace for what a carbon credit would be. So it's exposing this opaque carbon credit market to retail investors. And granted, the cryptocurrency hasn't done well, but this kind of like illustrates one of the use cases and how crypto can actually tackle real world use cases, right? And even like when you're, for example, trading within a liquidity pool, you use an NFT as a means to represent ownership of the liquidity pool, and you get rewards based on this like variable like NFT based on your share, right? So we can see like the concept of NFTs playing across like different like applications within the space. Another like very interesting innovation is Alchemix, which enables self-repaying loans. Essentially, they lock up your collateral stake, and then you can earn a yield on it. So since you can only get 50% loan to value, the staking interest can actually overcome the loan payments. So this was still, I guess, possible within like the high yield environment back in a couple of months ago. Maybe now, like I don't think it's possible. Like I haven't really checked, but like what it comes to show is that new types of products can be built on top of these primitives. Another really interesting one is called Pool Together, and this essentially guarantees a no-lose lottery. So it does this by using deposits and then earning interests from a DeFi yield source, then distributing the yields to depositors as a prize. So you basically, like the users, they lock deposits into a prize pool, and then the protocol stakes this in, like, let's say a vault in Aave, which is one of like the money marketplaces that exist on the Ethereum network. They earn some sort of yield. This yield goes into the price strategy, and then a random set of winners out of like a pool of like 10,000 depositors are selected. So the top 10 will basically get the bulk of the price strategy money, and no one else will lose, right? Another really interesting one is called Tornado Cash. And what Tornado Cash is they basically enable completely anonymous transactions, right? And this is like one of the things, one of the really like interesting protocols, as we'll see later, because it's actually been sanctioned by the US government later for money laundering. So essentially how it works is that you have a coin mixer where depositors put money into a single address, and then they can withdraw it to any arbitrary address on the Ethereum network using like their own private key. So essentially they can wash out their money, right? And it's a big issue right now because it talks about like, you know, the really interesting thing here is that the actual creator, the developer of Tornado Cash, actually got arrested for like writing code, right? So it's a very, I guess, quite touchy issue. Another application is golden.xyz, which is essentially a Web3 decentralized version of Wikipedia, where users submit triplets of information, which are the primitive of this knowledge graph that can be used to like power various D apps, right? So another like really interesting thing is cross-border payments, which are a feature of like crypto networks. So traditional infrastructure such as Swift, Visa, and MasterCard are basically at risk to crypto rails due to payments being simplified via crypto rails, since networks like Ethereum are really agnostic to geography. So if we see on like the left-hand side, this is like if I want to get, you know, money onto like to someone in another country, I have to like basically route through like 3 or so different banks and institutions, and imagine all the fees that are taken up there. Whereas in Ethereum, you can do it within a single transaction. So this is actually really interesting because I actually work with a developer in Myanmar, right? So he does like some like coding work for me, and it was actually very difficult to pay him via the traditional rails. So I actually pay him via the Polygon network in USDT, and he's into his Binance account, and he's much happier with that because it's much easier for him to get the money, right? So what we can see here is that in terms of like adoption of like crypto networks, I think more of it will actually happen in these third world countries where the payment infrastructure is not really like up to par. Whereas in developing nations, such as the UK, everything works. So it's not really, there's not really much of a need, right? So, and this also highlights crypto and crypto networks as being an opt-in system, right? It's also interesting because Visa is thinking of using Ethereum to settle USDC. And by the way, like in each of these slides, on the notes, I don't know like if you're going to distribute it, but like I provide like links to and articles to each of these slides. So in case you want to read further on each of these topics, like you can like click onto like the link to like to the news article to read more about in case you're interested. But Visa is using Ethereum to provide settlement services to custodians and exchanges such as crypto, Coinbase, and crypto.com via USDC. So we see like this kind of like merging of CeFi and Visa like acting as some sort of like intermediate crypto settlement layer for that. So I think a big opportunity space actually like within the financial sector is managing that. Like how do you do like B2B like cross-border payments, right? And you know, how do you comply with the different regulations of each country but still harness the power of crypto rails? And it's really interesting because BVNQ, which is I think it's a B2B global payment startup, I think which merged with a South African entity in 2017. It's launched 11 months ago and it's already valued at $340 million. So they had a 40 million Series A led by Tiger Global at 340 million post money valuation. They've increased their headcount by 300% and revenue by 250%. So this really shows the potential for crypto as a cross-border B2B payment mechanism, right? So we see like BVNQ playing it on the smaller side, but then on the larger side, we also see Visa acting as, you know, settlement layers for like larger players like Coinbase and crypto.com, which is super interesting, right? So, and that kind of like brings us to the whole idea of stable coins, which I think Connor has talked about, but like I want to like elaborate and expound on a bit more. So USDT and USDT, which are the world's largest stablecoins, are not actually government owned. And this actually is interesting because it creates this whole idea of the separation of money and state, right? So even if they are regulated, their combined market cap of all the stablecoins is actually greater than the network that they live on, Ethereum, right? And how USDC works, USDC is basically the stable coin of Circle, which is one of the largest like crypto companies. It's backed 1-to-1 by cash equivalents. So essentially you have US treasuries backing the USDC to provide stability to that peg, right? So even within stable coins, you have a variety of different stable coins. Usually the ones which are backed 1-to-1 are the safest. So if you see like there's very little exchange rate fluctuation because USDC is always fully redeemable for its cash equivalent, whereas USDT is not. So actually, I think 2 months ago, there was like a minor depeg in USDT, I think down to like 0.97 because of fears for the market, you know. When there's bearish market sentiment, this is usually like what happens, right? But since USD is 1-to-1 backed, it's actually much more well supported, and the peg holds much more. And you have this other class called algorithmic stablecoins. So I don't know how familiar you are with the Terra Luna collapse, but USD was this algorithmic stablecoin that wasn't able to maintain its peg because it wasn't even collateral backed. So it relied on like this other currency called Terra to maintain its peg. Essentially, how it works is that Do Kwon, who was the founder of the protocol, promised that you can always exchange one USD for $1 worth of Luna, right? So basically, when one USD like fell below the $1 peg, $1 worth of Luna was minted and created. But this led to an overinflationary death spiral. So this is similar to like the like Zimbabwean hyperinflation, where it increased by like over 3,000%. Except this happened even faster, where a $40 billion ecosystem virtually collapsed within the span of 2 weeks, right? So it's quite crazy how like this all happened. But yeah, and the metaverse can also be used to basically promote sustainability. So bring the conversation back to the metaverse. DVS is entering the metaverse via like the game, the sandbox, and it's actually profiling social entrepreneurs in Asia who've been driving impact through these innovative business models. So DBS like works with a lot of different partners from the government, and what they're doing is actually purchasing carbon offsets, such as the land and production on DBS Better World will be carbon neutral. So right now, a lot of like these companies are entering the metaverse to basically signal to the public that, you know, like, hey, like I'm innovative. I've got my eye on the metaverse, but there is no real, I guess, financial application yet. Especially like in the sandbox where it's much more of like an open playing field, like a Minecraft of sorts, right? NFTs as well, they provide the ownership primitive within the metaverse. So Helene talked about JP Morgan, who bought a piece of land in their Onyx lounge, and they actually became the first bank to enter the metaverse in 2022. And their thesis was that in time, the virtual real estate market could start seeing services much like in the physical world, including credit, mortgage, and rental agreements. Virtual land also doubled, I think, from $6,000 to $12,000 in the latter half of 2021 across all the different metaverses, right? And this like kind of brings us like the idea of crypto as the currency for like Web3. So what is this link between financialization and gaming? So it's really interesting because gaming is actually the first instantiation of a sophisticated financial economy outside the real world. And crypto enables one to realize gains of these of the in-game earnings. So I don't know how much of you are gamers, but like I was a big gamer, and EVE Online It's this game which was launched in 2003. And it has one of the most sophisticated economies up until now. So even for like almost 20 years, it's had this very like robust economy, right? And even there was a big battle fought at one of like the sectors in this gaming world where 380,000 of US dollars was lost, right? So the issue here is that their native currency, which is called ISK, had to be traded illegally against USD. And item trading is illegal according to the terms and conditions of game developers. So the thing with NFTs is that it allows the user to have real ownership of these assets, and it legitimizes this trading. So essentially, this allows like financialization to blossom within the in-game economy. And this is why like everything that's happening in the metaverse that's at the cutting edge is happening in gaming, because gaming is the closest to like the real world financialization. So here's like an example, Ice Poker. So this was launched in 2019. Users can earn ICE and DG tokens for playing, and this currency can be legitimately traded against USDC stablecoins, right? So it's taking the idea that was happening in EVE Online, you know, like making money by playing a video game, and actually legitimizing it, right? And what's interesting is this Ice Poker Casino is inside Decentraland, which is like the place where JP Morgan bought their own lounge. So essentially, it's a game within a game. And how it works is that users hold these NFTs, which are wearables, right? Like this suit, these boots, and then they're eligible to play and earn rewards whenever they win. So these can be traded for stable coins like USDC to lock in earnings, right? NFTs also allow new businesses to be built, such as scholarships. So Axie Infinity, this was like a game that was launched in December 2017. And at one point in time, it enabled people in the Philippines to earn almost double the minimum wage through just playing games. So what they would do is they would rent NFTs from asset owners and use the NFTs to earn in-game tokens. So a simple analogy I use to explain it is that they're essentially miners. And me being the asset owner, I have the drill. I have like these like digital drills, and I tell them, hey, you can borrow this digital drill and then give me 50% of the gold that you find. So instead of me like using the drill to drill myself, I find someone who's willing to use the drill, and we have this agreement where we like split the money. So, and these tokens can really be exchanged for real world items such as these shown below. So these are like images taken from the guild that I used to manage, where you see here, like on the bottom left, people were able to buy medicine for their grandfather through like this NFT. This grandfather was diabetic. Another one was also able to buy a laptop from the money they saved, like thanks to Axie Infinity. And then on the right, someone was able to buy their own like office supplies. And this is what I find like really fascinating about this model. It creates this like, it realizes like the geographic kind of arbitrage of like labor, right? And this is what first like rose in this whole like play to earn economy, right? So it was good while it lasted, and actually like Sky Mavis, they built their own economy inside of the game. So later, like down the road, like when they saw this activity happening, like you had to use other chains and other exchanges to actually pull your money out and exchange. They built their own economy inside the game. So they built their own automated market maker called Ronin, right? So this basically shows you like the financialization that happens within a game. So everything starts off with like the NFT, where like you can like kind of like earn, where you have like you have like utility, and then like as the economy develops, then you can build tooling, financial tooling around this, right? However, this was kind of like Ponzi like. So I don't want to like paint like a rosy picture that everything's perfect, because overinflation was eventually what killed Axie, where demand for NFTs could not keep up with supply. And this was because the mechanic of like the demand for the SLP token, which was like the like utility coin, which was made when you won a game of Axie, was used for breeding other Axies. So it would only like work if like there was actually more demand for Axies. So once supply of the NFT assets overcame demand, that's when the price drop happened. So in this graph, like you can see at one point, like you were really earning more than the minimum wage. But then after a certain point, no matter like how well you are, so you have 700 MMR to 2,200 MMR. So like these are like the top players, the earnings of the top players. No matter how good of a player you are, you still could not, you would barely make below minimum wage. You made much more below minimum wage after like a certain point in 2022. So this shows that there's still no sustainability for these kinds of schemes, right? So what does this really mean for like traditional finance? Like looking like in regulations across geography, crypto is still relatively lightly regulated. Like we see like a lot more heavy regulations in Canada and China specifically. US as well is starting to like come up. But they're probably like the slowest in terms of like regulation. Well, and firstly, they created like a bipartisan legislation aimed at regulating the crypto markets on June 7. But this will still most likely be rolled out in 2023 because senators still need time to digest their the approval. And there's also like increasing pressure under the SEC to clarify when crypto asset providers actually need to register with the SEC and comply to these additional requirements. It's interesting because the Federal Reserve is also continuing to work on digitizing the US dollar. So they actually have a white paper here, which is linked in the presentation. But they have like a lot of the board members showed a very positive attitude towards like a central bank digital currency. So we can see like this theme like recurring in the EU, where the EU is perhaps the most forward thinking, right? And there's potential legislation for CBDCs to come in 2023. Right. So, and the European Central Bank is also very active on the whole idea of like the digital euro, and they're planning to run a test pilot later in the year. Right. And with the UK, it's still a little bit like more bearish. The UK government have been pushing for a crypto sandbox to allow crypto providers to test new products in a safe regulatory environment. I think also like they were thinking about issuing NFTs like last summer, although that hasn't happened, like a government approved NFT. But they've also like banned like the world's largest crypto exchange, Binance. So they are, I guess, like not as optimistic, and they're not looking to like to get into like any CBDCs for now, right? So in Indonesia, like it's very interesting because there's actually like 11 million people who have like digital asset holdings, and the trading volume 57.7 billion is a lot. It increased by 1,000% since 2020. But despite that, the Indonesia still bans these digital assets from being used as a currency, right? And I think the Indonesian central bank is thinking about like the use of like a central bank digital currency, which is an alternative legal tender, right? So this is a much more, I guess, forward thinking than in the Philippines, which is where I'm from. Right. But we see that despite all of this innovation, like this regulation is still needed. So the US sanctions, like actually, the US Treasury actually sanctioned Tornado Cash because 455 million was stolen by like the Lazarus group. So there was a big DeFi hack that happened with Axi's Ronin Bridge, right? I think like a large amount of money was stolen, and they actually used Tornado Cash to actually like launder the money through this, right? And there's also Pulled Together, which was like the protocol that I talked about, where it was like a no lose lottery. It was actually like sued, right? So now like they're using NFTs to like raise funds to like combat this lawsuit. So even like despite all these innovations, there are a lot of regular people who are like being like affected by this, and you know, it's a difficult kind of thing. So what we see is like traditional finance will need to embrace Web3. HSBC, like they bought NFT land in the Sandbox Metaverse. Goldman Sachs says it's exploring like the tokenization of these real assets. And firms should really look to integrate crypto into their offerings. So JP Morgan extended banking services like Bitcoin exchanges. Fidelity also launched their own Bitcoin fund for these wealthy investors. And PayPal is also enabling a new service to buy, hold, and sell cryptocurrency. So we see a lot of these payment networks actually getting more into cryptocurrency. But what's interesting is that the innovators could actually be from like the non-financial sector. So Louis Vuitton released this NFT game, which racked up more than 2 million downloads, I think within the span of like 2 weeks. Also, Starbucks, which I think this news was like fresh from like 2 days ago, they're actually partnering with Polygon to offer like an NFT-based loyalty program. So they're one of like the big Fortune 500s that are actually using NFTs right now. And these are essentially digital collectible stamps, which can be redeemed for like special rewards, right? So now like is the time when big companies are actually starting to explore like the use cases of like NFTs and as a means of like loyalty, right? And it's really interesting because usually like loyalty programs are closed off, but using like an NFT, it's basically open. So you could basically sell your loyalty points on a permissionless pool or another like NFT marketplace, right? And I think a lot of like people will be looking like to see how Starbucks like implements this. And there seems to be also like a lot more adoption in Southeast Asia for these digital assets. So the Bank of Thailand actually in 2019, 2020 issued like a baht bond where 50 billion of Thai baht was basically put and deployed on the blockchain. So Metaverse is this permissionless opt-in country. NFTs are the property and crypto is the currency, right? So we can think of like, we usually like see the metaverse like as a, you know, a virtual reality sort of world where we like interact. But like for me, like I see that really the metaverse as like kind of like different countries where you can like adopt and which have their own like financial sort of economy. NFTs are the properties which you have, which represents like you within that metaverse. And cryptocurrency is the currency that fuels the interactions, and everything lives on a public blockchain, right? So you can think of like, you have like the sandbox, you have Axie Infinity, you have Decentraland. All of these are basically open metaverses. And you can define the metaverse as the umbrella that kind of like covers all of these. And to conclude with my presentation, because I think there's going to be like a lot of questions, because so much of our lives are digital, we need to think of how to regulate the metaverse instead of countries. I think what we've seen is that crypto enables experimentation at a scale we've really never seen before. So we can have like different monetary policies. You know, we can try to create algorithmic stable coins and see if they work. But, you know, like as we've seen with like Terra Luna, like they still probably don't, right? What NFTs do is they enable this true asset ownership within the metaverse and have this real utility in them. Like you've seen like within Axie Infinity, like there have been scholars that have actually like earned real income, bought real world items using these NFTs, right? And despite the horrible UX within crypto, like they still manage to overcome all of those in order to like buy these assets. So this is why like I'm very positive about crypto, despite, you know, like the bearish sentiment and the market downturn. Like it's proven and shown to me that there's real promise within the technology to, you know, enable like the less fortunate to like actually earn by creating new models of like capital and which are not winner take all, which are not like zero sum, right? Also, like what we've seen, one of the issues that governments cannot really touch these assets because they live on the blockchain and are decentralized. The whole idea of a decentralized network is that even if you shut down all the computers which run the shutting down all the computers which run the Ethereum client, you'd have to like ask all the governments to across the world to coordinate and get all of them to like shut down the computers and basically take down the whole internet. So therefore, like it's very difficult for like these assets to like even like be seized. Despite that, we still have to be able to protect citizens, and we need to find some sort of middle ground between this regulation and experimentation. And I think this is somewhat happening, but it's still quite you know, it's still quite in its early stages. But like what's promising to me is that I think a lot of bigger companies, UNICEF, Starbucks, are beginning to experiment and dabble into this technology because they really see the applications. And the cutting edge is really like in the gaming space, where we see like games like Axie Infinity, who are really the spearhead into showing that these virtual economies are thriving and have value. And actually, at one point, the SLP currency could be used to make a down payment on a car and an apartment within the Philippines. So even though like that mania has passed, like it comes to show that this is the promise for like what Web3 could bring. You know, you may not even have to like create your own system within the country. You could just opt into like the most open, decentralized, and censorship resistant network, right? And that is, I think, a very attractive proposition for countries who do not have the resources to build their own infrastructure. So that kind of like concludes my presentation, and I guess we'll move on to like a Q&A. Are we going to like have an open conversation, or should I just like read the questions and talk? What works best, Vera?
Okay, thank you, Eddie. We want to. Okay.
should I try to answer some of these questions that you see on the screen, or like what works best, or should we have like some sort of panel discussion?
Thank you very much, Mr. Eduardo Litonjua, for such insightful session. So, ladies and gentlemen, we have come to the questions and answer session. In first sections, you may type your questions via Q&A feature with format name _ institution name _ speakers _ questions. All the questions can be submitted in English and Bahasa. Well, the first questions from Bapak Ahmad Suhendar. And the question is to Helen Panzarino. The question is, what is your opinion of cryptocurrency? Should they replacing the currency that issued by the government, or should they play alongside with the conventional currency? Helen.
Thanks, Vera. And actually, I think Connor and Eddie are probably in a better place to speak on this. But personally, we're at this point where governments are entertaining central bank digital currencies, cryptocurrencies, and their volatility. And there are questions I can see that are subject to security and hacks, are not at a point now where I think they're replacing currencies. That we're still, as we've seen from all the presentations, in an experimental stage, and they're running alongside them in different varieties. Obviously, stable coins, which Eddie was just talking about, Connor mentioned as well, are different to a pure cryptocurrency. So I'll let them add their comments as well. Connor?
Yeah, sure. So I certainly agree that it's likely that, well, personally I believe that these the cryptocurrencies, as they become less volatile, some of them will get treated as currencies in their own right, but the vast majority of I think the wider adoption we'll see within the monetary system is that the technology behind cryptocurrencies, i.e. blockchain, gets embraced by these central banks. I know that Eddie spoke about some of the regulatory challenges and the support for these coming on slowly. But long term, it completely makes sense because it will just bring much greater efficiency. Now, in terms of the time horizons associated with this, we're not talking years. We're likely talking potentially decades, for this to happen. Because if you think about many large financial institutions, a lot of them are still using mainframe technology for some of their core systems that were written in the 70s, and so there's at one side, technology change can happen very quickly, but on the other side, certain types can take a long, long time. So those are definitely, in my view, the considerations there.
I think maybe to add, like what's really interesting is that especially like in the Philippines, there's a large proportion of people who are unbanked. So actually, like a lot of the people who are playing Axie Infinity, that was their first time interacting with finance. So I think one of like the key things that could accelerate or adopt cryptocurrency adoption by the government is that people don't need to have like bank accounts. They don't have to like be with a bank in order to like actually hold their money. They can have like their own like funds in like in a self-sovereign way. I think they just have to warm up to the idea of like of that, and it's quite a difficult concept. But even like, for example, with Circle, there is, for example, a smart contract that can essentially blacklist USDC, which has done illicit activity. So I think if the government can create some sort of system like that, and the technology like advances, I think you can have like the best of both worlds, where you have the regulation, you have like some regulation, but also like the openness and being able to opt in to the into the new like financial kind of like regime.
Okay, thank you, Eddie. And the next question is for Connor Svensson. It's from Ibu Treva Nata Chandria. The question is, does fintech provide advantage for encouraging the transmission of economic policy? Connor.
So with the fintech angle is certainly a very interesting point to bring up. With regards to the monetary policy, I guess I'm less qualified to speak around the fintech specifically and how they've influenced monetary policy. I know that certainly for a lot of fintechs, it can be challenging to get the necessary regulatory compliance they require to carry out some of their activities. However, what I am very aware of, and this is from conversations with some of the fintechs we've been speaking to about within the context of Web3, fintechs a lot of the time have come to market with their own greenfield platforms. They don't have that same legacy technology that many other incumbents bring to the table. And so as a result of that, they're generally better placed to be able to embrace some of the opportunities associated with blockchain and Web3 type technologies. And so certainly a trend, while it's not regulatory driven, but they are working within regulated businesses, is them thinking in terms of how they can embrace this technology to further their goals and as a fintech platform. To give a concrete example, we've been speaking to fintechs within the settlement space, and some of these have got their own closed networks of different financial institutions that they work with on those networks for different types of activities. And there, in their minds, there's a great case for actually having a blockchain network to provide some new additional efficiencies there. So they can be a driving force there. And that's where I think there is some really interesting things happening, because the fintechs, especially now, given where we are more broadly from a macro perspective globally, and some of the challenges that some fintechs have had with respect to creating those, the revenue streams and sustaining the revenue streams they've wanted. They're looking for new opportunities to innovate, potentially more so than many of the incumbents. And so with that, there's a lot of activity focused on Web3 and blockchain technology.
Okay, so Helen, maybe you have another perspective?
I think also commenting on monetary policy as a non-economist, the monetary policy as it would have been 6 months to a year ago is very difficult, because the world is in a very different place now with regard to our economies and inflation and everything else. And I think that at this point, as Connor mentioned, fintechs have the privilege of dabbling into different technologies. Central banks, we've seen it with the Bank of England here, they have a whole crypto unit. They are experimenting, and they are looking at how you can use other currencies. Not every cryptocurrency, the blockchain is one way to go. And Eddie mentioned something on the SWIFT chart before. It doesn't mean that we're knocking out the whole of the correspondent banking network and that this is the only way to go. And we're not going to rock up to our central banks with our checkbooks or our pay-in books saying, I want my cryptocurrency. I think the tendency to go all or nothing in the community, and actually even thinking about what we're talking about today, to imagine that some of the concepts that we're discussing today are live and active and making genuine impact right now at the early stages of things that are developing, like Web3 and the metaverse. We should not assume that this is where we'll be in 2, 3, 4, 5 years from now, or that this is a blanket swipe and everything goes out the window. It's a really bad tendency in fintech to go one or the other. I think what's come across today is that all of this is experimental. All of it is running in parallel to what's happening in our regular monetary policy, our regular banking lives and everything else. We're not all in the space yet where we can adopt this fully. Yes, it helps with inclusivity. Yes, and we know that a lot of people are outside the banking system, but it doesn't mean that this is the only way that we'll get people into the banking system or into a financial system somehow. So I think resist the tendency to go all or nothing.
Okay, thank you, Helen. So the next question for AD from Bapak Rian Fajar. The question is related to NFT. Based on your experience, how to prevent piracy if NFT used to become credit guarantee? Is there any mechanism to value an assets? Is there any second market that can receive if the credit was bad? Adi.
So basically your question on NFT, when you say like piracy, and I'm assuming you mean a fake NFT.
Yes.
The NFT basically lives on the blockchain in of itself. So you can't really like pirate the asset You can make copies of it. So you can make a copy of like the JPEG of itself and like save it and put it as your profile picture. But you can basically verifiably prove that you actually own the NFT because it lives on the blockchain. And the blockchain being a tamper-proof database, no central party can basically like change the location of that NFT. And on your like kind of like being like used as a credit guarantee, there's also like there are like sort of like mechanisms right now, early mechanisms like value NFT as an asset. So you can actually, there's some platforms where you can basically put your NFT up on a loan and you can borrow against it. And I think there's I forgot the name of the platform, but I think you can borrow 20% loan to value of like the floor value, right? And I think the way they do it right now is that it's only with like the top 100 NFT collections where there's enough trading activity to actually value the NFT of itself. So it has to be like a legitimate sort of collection, like a Bored Ape or a CryptoPunk. And then essentially you can like lend the NFT into a vault and like borrow like 20% loan to value in ETH, right? So there is some sort of like secondary market mechanism for like identifying that. And usually you have a smart contract which basically watches the floor price, and if it falls below a certain threshold, you basically default and you lose control of that NFT, right? And I think there was a story where like this happened, and it actually triggered a cascade of like crash in like a specific collection, but I can't recall right off the bat, but it's not good like right now, because, and that's why the loan to value ratios for these NFTs, especially art ones, are very low, because a lot of their value is really quite speculative. I don't know if Helene and Connor, you have anything to add to that, but that's kind of my take.
Okay, thank you for your explanation. So the next question for Helen, it's from Bapak Andi Yuliman. The question is, will cryptocurrencies take over the dominance of financial transactions? And why are the world's top companies starting to invest there? Why is the regulations of the world's central banks so resistant to crypto? Helen.
Yeah, I think this kind of circles back on what I was talking to you before. The resistance, I mean, you see in the European Union where they basically come out and say it's gambling and it's a Ponzi scheme, walk away. And then, if I take an example, I went the May 24th to 27th, I think it was, that the ECB came out with something saying to stay far away from cryptocurrencies. And I was sharing a panel in New York with the CEO of a company called Celsius, which then went on to whether or not cryptocurrencies were going to be the financial solution of Web3. And he was very bullish. And 2 weeks later, his company just crashed and 2 million people were locked out. And he went into insolvency, bankruptcy, et cetera, right? And there was a question about the arbitraging or the matching of it was like a run on the bank, essentially. So I don't know that there's a resistance. I think that everyone is very aware of protecting the consumer, that this is a really nascent technology. I think when we think about everything that we've heard today as well, and I was making some notes about, the smart contracts in the real estate environment, for example, payments, smart contracts in payments. If I was buying something in the metaverse, for example, and I wanted to make a peer-to-peer payment, in the real world, peer-to-peer payments that have come out in the last few years generated an incredible amount of fraud, which we don't often speak about. So if you have, an immutable chain, you can start to eliminate some of the fraud. I think we want to imagine that right now all of us can get onto these different interoperable metaverses and start transacting with each other in a very safe environment. We're not. And if I listen to Eddie and I listen to Connor and I listen to what I'm reading and watching, we're not there yet. People are putting their stake in the ground because, as Connor said, the technologies are very powerful. And things like smart contracts, which we can see for the creator economy, that could open up a whole, if you're a fashion designer and you can't get onto a runway in New York or Paris, you can get onto one in the metaverse. And you can start selling your products and services that way, and then continue, like you said, with art, to make royalties as it moves on. This is a very experimental space right now, but some of the technologies are going to enable some real-world banking financial transactions. I think central banks are watching. Mm-hmm. I think parallel currencies definitely are in the mix. I mean, if you look at something in China, for example, where they're launching the digital yuan, when I look at that and I look at folks like Alipay and I think, are you going to be excluded from that environment? Because the people and a certain generation will want to go for a more trusted currency that's an immediate transaction without having to go through an intermediary platform. It's all being discussed. It's all experimental at this point. So I don't think there's a resistance. I think there's a watch and learn.
But is it secure, Helen?
Oh, I'm not, Connor, you're probably best to comment on the security element of it.
Okay. Thank you, Helen. And for the next question for Connor, it's from Bapak Henry Dwiasa dari Bank Mandiri. The question is, cryptocurrency is about anonymous transaction. How do you correlate this with CBDC, where one of the purpose is to be able to trace the money flow? Connor.
So one of the misconceptions really that many people have is the privacy associated with cryptocurrencies, because whilst participants on blockchain networks are anonymous in terms of you don't know who you're dealing with at the other end of a transaction, they're not KYC'd, all of the activity is recorded on the blockchain ledger. Now, there's a lot of additional information that can be given about people's activities that take place on a blockchain, which can actually trace it back to the individual. So whilst at one level you'll be speaking, you just have this wallet that's being interacted with. As soon as a wallet that someone owns interacts with like an entity to purchase a product or go through an exchange to convert cryptocurrency back into fiat, you'll be able to all of a sudden tie those funds back to the user who did it. And in addition to that, there are more sophisticated techniques that can be used as well, such as seeing things like the regions of the world where transactions originated from on the ledger to indicate where they were sent from. So whilst on the surface there's this anonymity that comes with these blockchain networks, it's in fact far more traceable than the physical monetary system that we have right now. As in, if someone goes to a cash machine and gets some cash out, yes, that could be tied to an individual, but then all of the spending that they do with that cash, you kind of lose track of it. Whereas with cryptocurrencies, it's all happening on chain, so it's all traceable. And in the vast majority of cases, there will be a point where a person takes that cryptocurrency and exchanges it for something where they have to identify themselves. And so there's actually a lot of visibility there, which most people do not realize. Now, in the context of CDBCs, this is, I would argue that the intent there, it's not to be able to trace exactly how people are using currencies in that context, because if the vast majority of the financial transactions that take place even right now are through online banks or payment providers that are tied to a KYC'd individual. The cash market's only quite a small proportion of the overall spending that happens globally. And so with that in mind, CDBCs do provide that traceability because they're using blockchain technology, but it's not really the end goal of using them. The end goal of using this technology is more about the efficiencies that it brings, and being able to trace what funds are doing in some cases is important, but there is also a real case to be made for empowering people to have a right to privacy as well in terms of what they're doing with their financial affairs. Now, of course, within the context of the regulated industries, that can sometimes not sit so well because of concerns around the money laundering, terrorism financing, all these sorts of things. But there are, of course, genuine reasons why people want to be able to do things, undertake transactions in an anonymous manner, such as if they wish to donate to a political cause that they don't want people to be aware of, or there's been multiple people who've been making donations to the people of Ukraine, given the recent war that's been happening there. And so there are very legitimate reasons as well for that. And so it is important not to lose sight of the importance of privacy there, but we're kind of in this earlier phase where people are less comfortable with privacy because there have been some bad actors on these networks, such as the North Korean hackers who used some of these privacy platforms like Tornado Cash, which we've already mentioned, to siphon money, to put it somewhere else. But I think the key point is that transactions on blockchains right now are far more traceable than fiat ones, but within the context of CBDCs, it is something that's helpful with it, but it's more about the efficiencies that come to the market with that are key.
Okay, thank you, Connor. And the next question for AD, it's from Bapak Edward Ken. The question is, can someone has more than one decentralized identity or DID? If cannot, how to mitigate someone to have more than one DID? AD.
I think this is something that Connor's already like talked about. I think you can have multiple decentralized IDs, and actually with this thing called zero knowledge like
Okay,
technologies.
sorry.
you could-
Please up your volume.
Oh, can you hear me? Hello?
Yeah. Okay.
Can you hear me? Sorry about that. I was saying, I think Connor mentioned this a little bit before, but I want to add something on. You can have your decentralized ID, but I think one of the really interesting things about crypto is that you can actually use this concept called zero knowledge technology to actually share credentials to a utility or like a service provider without actually disclosing your identity. So you can basically mention that, oh, I have at least $5,000 in my bank account without giving my name, right? So actually, like, if this is technology is still maybe 3 to 5 years away, but this allows us to have privacy, but also to be able to like use services which require some degree of KYC, right? So I think like with these decentralized IDs, I think you'll have an amalgamation of different DIDs, but then they'll kind of like be wall gated by the zero knowledge technology. So you can choose actually what information you want to share to specific services. So you don't have to share your name to a service. You might just share like, that you own more than $5,000, right? But I think that's the promise which crypto really brings. It enables this new concept of what privacy is, more of like an opt-in kind of like privacy. Yeah. I
Okay,
don't know
how
if,
to make sure to the security about it?
Well, the security is basically like it's sort of like self permission. So instead of like storing it in some sort of like centralized database, like you'll have these like IDs and credentials. I mean, like it can be verified by like a third party, but then the proof of like the ID itself exists on your own computer, for example. And this is slightly riskier if you don't, like if you're not used to like holding your own keys. But I think it could also be like a safer way because, for example, you cannot get your like bank account frozen. Like in Canada, I think there was a trucking protest and riot, right? And people who supported like the protest, I think there were 14 or so bank accounts that were frozen, and the government can easily do that. So actually, like if you hold your own keys and you have like your own kind of decentralized identity, that cannot happen. So you can have basically your funds and you can take it wherever in case the country like goes haywire or something or goes against its citizens. And I think like when there are like these interesting times, you never know like when this is kind of going to happen. So arguably, if this zero knowledge technology plays out like in the next 3 to 5 years, it could actually be safer for you. Yeah, I don't know if you have anything to add to that, Helene or Connor.
Okay, Connor, do you have another perspective?
Not as such. I think what Eddie said there, I think sums it up well.
Okay. Okay, we are going to the next question. Okay, this is from Bapak Pandu, from DPKN, okay, dari DPKN. The question is, the convergence and maturation of metaverse concept may bring its full potential to life faster than many people imagine. Things are moving rapidly, and banks that are not thinking about their strategy risk falling behind. Those that are thinking big, experimenting on a small scale while getting ready to ramp up that at speed, will gain an early advantage that will stand them in good state in the long run. But in more realistic form, how to how the metaverse can actually provide real value to company, brand, and business. Is metaverse experience effective enough to find new opportunities? Is there more to the metaverse than hype? Okay, Helen first. Helen? Can you answer first? Okay, we are moved to Connor. Connor?
Yeah,
What do you think
I
about
can
that?
jump in. So what I would say is that with the metaverse, it kind of needs to have its equivalent to the iPhone moment. If you think about what it was that was a really pivotal moment for bringing a lot of people online, it was when Apple launched their iPhone. It wasn't just necessarily the iPhone on its own that made what has become this kind of smartphone-based, I suppose, economy and widespread ecosystem what it is. There were other technologies behind the scenes, such as the web and cloud and so on. But what the iPhone did was it kind of rewrote the rule book of what was possible with respect to consumer tech and also the online experience. For those of you who remember, prior to the iPhone, we had dedicated protocols such as WAP that provided like a stripped down internet, whereas basically the iPhone brought everyone was able to use the World Wide Web, but then they also started creating apps as well. And just the level of interactivity and engagement just went through the roof. It was such a pivotal moment for the adoption of the internet. And we're now in a position where more people use smartphones to access the web than anything else. And a lot of that's through apps. Now, we need to have that same moment for the metaverse. And we're certainly not there right now. We have these devices like the VR devices like the Oculus, the AR ones like Google Glass they're a bit clunky. It kind of works, but it's not something that your average person is going to be incentivized to use like they would pick up their phone to connect with people or email or message someone or whatever else. And so that is kind of a key stumbling block there. And when that sort of widespread adoption happens, that will lay the path for so much more innovation and products being launched to market. I think a really, really great way of thinking about this, especially from a business perspective, and this is relevant for finance as well as other industries. Nowadays, you have most corporates provide services to engage with their customers via Twitter, WhatsApp, and also Facebook Messenger. And so what we're actually seeing now is, whilst the first kind of mass adoption of smartphone technology and these consumer messaging devices was consumer driven, the corporates have now come in to see how this works. I don't know if, and again, I'm sure that the landscape, I'm sure there's many areas as well there in Indonesia where and other parts of Asia where there's been probably a jump ahead of how things are here in Europe with respect to these sorts of services. But like using WhatsApp, for instance, to talk to support services and message them is so much more efficient than using a phone. And so we're kind of seeing it come to fruition, the smartphone movement in the corporate environment. And I believe that we need to have this big catalyst for widespread metaverse via AR or VR to happen before it can really be embraced. And that's not to say, as per the person answering the question, that we should ignore these. We shouldn't be thinking about opportunities. Of course, there's some really obvious use cases, like if you're dealing with customers, why not do it in a VR scenario, instead of having to make them go to a physical branch? But the technology is still quite clunky. And so this is, in my mind, a barrier there. So the way I like to think of it is we need to have that iPhone moment for this, whether it's AR, VR, or some sort of take on the metaverse that really brings that mass adoption of it. And then that new products and services to service that will, really flourish.
Okay, thank you, Connor. And for the last question is for all the speakers. Okay, this is from Bapak Wisnu. The question is, payments in the metaverse will include both legal currency and digital currency. Which one is better between centralized and decentralized currency in the metaverse? Okay, Connor first.
It's a tricky question, and I think it in part depends on how soon this broader adoption comes to fruition. If it was to happen in the next year or two, for instance, I think what it would look like is it would be mainly via fiat currencies using well-established payment rails. If it was on an Apple platform, it would be using Apple Pay. If it was Google's, it would be Google Pay, because this is where these companies make some very good revenues. But really what is required for digital currencies to become the native currency of these is you'd have to have like a metaverse type experience or gaming experience that gains a huge amount of popularity, that came from a place that wasn't an incumbent, it was a new entrant to market who managed to do something that just pulled in loads and loads of people, and they were really embracing this decentralized sort of narrative. And I think, in all honesty, it's less likely to happen that way. I think it's more likely that because of the investment required to get this stuff right, it's going to be whether it's one of the gaming engine platforms coming to the market, or whether it's one of the big tech players who start to create some really valuable platforms there. It's likely that those are the places where this stuff will come from, and therefore it's most likely to be fiat currencies there. So I do think that there's the potential for the digital currencies to flourish, but I think it's more likely that they flourish as a result of there being broader adoption within society over it being metaverse specific that brings it in, if that makes sense.
Okay, thank you, Connor. And next, Eddie.
So like, I think for me, like in terms of like which currency will be used in the metaverse, I do think like there's a lot of like benefits and advantages to using something like, for example, like USDC. But I think like for like the average user, I think they're still like more comfortable with fiat. So I think maybe a lot of like the gaming developers, they would probably like abstract away that concept. They might use fiat rails, crypto rails, for example, to like settle if you're doing a cross-border transaction, right? Because in the metaverse, you just have kind of one world. But if you have one player in the USA and one player in the UK, when you're doing like the underlying payment, you might not want to use Swift. You might want to use, let's say, Polygon instead, right? So you would kind of like, I guess, like abstract that away from the user. So like I think of it in the sense that like when I type in a website, I don't think about TCP/IP or HTTPS. I just think of like the website that shows. So I think like as the metaverse develops, like this concept of what currency like is used, I think becomes abstracted away from the user. So they just like do like an exchange in like a USD, right? But then on the back end, the actual service provider might use crypto rails or traditional rails depending on like the specific use case. So I think that's how it's eventually going to play out. So you don't give the users the choice as to like what to use. You don't give them that mental fatigue. You just abstract all that, and then that goes into like the background, right? Similar to like how we see websites today. We don't really think about like the underlying data packets that get sent through the error correction which happens. We just like type in a website URL and it kind of happens. And I think that's what we want to move to in the metaverse, a very seamless interaction where we're not thinking so much about the underlying. But my kind of thesis is that for cross-border payments, I think like crypto rails are far more effective. So probably one of the more like well-established coins like USDC could work for that.
Okay, thanks, Eddie. And the last is Helen. What's your answer? Helen, please unmute your audio, please. Oh, okay. Okay, thank you, Helen.
Now I can. The host is
Oh.
controlling. Thank you very much. As I mentioned before, the whole of the UK is online, so I did drop off there for a little bit. There's not much more to add to what Connor and Eddie just said. I think one thing again, I go back to this all the time. The metaverse, if I'm a bank in the metaverse, or I'm a central bank in the metaverse, I can use it as an educational place to educate the population. You know, we're talking about people who are using cryptocurrencies is in a very esoteric way. I think first and foremost, we have to educate people, and we have to get the technology to a point where that user experience is not having to put on a big headset, for example, and be very clunky, as Connor said. Otherwise, people aren't going to use it in that way. So when we're having a conversation about theoretical discussion that we're a few years away from, back to the Gartner hype. But I do think there are always early adopters. And in this case, I think it's the creators that are doing it. And for cross-border payments, I do agree with that. Yeah, I can see it.
Okay, thank you, Helen, for your answers. And there are some points that I have highlighted. There are multiple layers of competition and collaboration between incumbent banks, fintech, and big tech. Regulation as an enabler of innovation is under security. Regulatory oversight on competition is stronger. Emerging markets grow stronger, maximizing digital acceptance and lack of legacy hurdles while attracting global investors. Okay, thank you so much all. Distinguished guests, ladies and gentlemen, thank you for your attention and enthusiasm. There are lots of questions, but we cannot deliver to the speakers due to limited time. And before this session ends, we invite Ms. Helen Panzarino, Mr. Connor, and Mr. Eduardo to deliver closing statements for this webinar. Please, Ms. Helen first, the time is yours.
Thanks, Fira. Yeah, not to labor and the points, but also you gave a very good summary. I think for financial services, and I'm coming from an education perspective, we absolutely need to educate ourselves about what the possibilities are. We need to be really clear that we still need to protect the consumer, that we shouldn't actually just assume because something exists that it's ready to be rolled out in a very broad spectrum, that we should look at the technologies and look for the use cases that are born out of those technologies and apply them to the banking world. We can't disassociate what's happening in other realms and say, well, that's not banking, so it doesn't really apply to us. If you think about Spotify and that model of music delivery, how that was a Spotify moment for banks being disintermediated as an intermediary, we need to learn from what's happening now. And then we need to watch and see where the use cases are that we can put it into financial services.
Okay, we need to learn and educate people, yeah? Thank you, Helen. And for the next, Mr. Connor, time is yours.
Sure, thank you. We, in order to, and this kind of builds on what Helen was saying, that in order to really educate and think about how best to embrace these technologies, in my view, there's really two perspectives that need to be thought about. One of them is near term, in terms of over the next 1 to 2 years, what are the ways in which these technologies could have an effect on our business? So at least ensuring that there's a strategy in place that talks to whether it makes sense to be how much it makes sense to be investing in learning or engaging with the technology is very important. It can be that you spend time looking at it and walk away and decide now's not the right time, but it's important to at least spend the time looking at it and taking it seriously with that view. The other side is to be thinking in terms of long-term, 5 to 10 year time horizons, where the technology and the landscape could be and where you'd like to be positioned to it. So having this near as well as long-term view is very, very important. And it's the main thing there is to just spend the time to investing in, whether it's thinking strategically or doing pilots or whatever else, but you need to create your own, make up your own mind on it. And with that as well, I cannot understate the importance of actually ensuring there are people getting hands-on with this technology. It's all well and good me sort of here talking about challenges with Web3 adoption, usability challenges, and so on. But it's only when people actually try doing these things themselves, and I'm not saying that everyone here, but people within the organization should be at least experimenting with it, getting familiar with what the reality of this stuff looks like. And it can be small, trivial things that maybe people do in their spare time, like buy a cryptocurrency, send it to a cryptocurrency wallet, purchase a very cheap or minimal cost NFT, but just have a way of engaging with the ecosystem right now. So you understand, whilst there is everything you see in the media and the news about it, there's also the reality of what it really looks like to engage with it, because otherwise it's hard to kind of form your own opinions there. So to kind of sum it up, it's ensure that there's a near-term and long-term strategy in place, which could be to do nothing near-term, but at least doing the diligence to, to back that up. And then ensuring that people, or you get some hands-on experience to really understand what the state of play is at this point in time.
Okay, thank you, Connor. And for the last, Eddie?
I think I'm approaching this from a much more kind of like being at the forefront, like doing like the whole gaming thing, being in the metaverses, and it's really taught me so much more than like just reading could do. Like I remember like when I was in back in 2021, I knew nothing, right? But then like by going into like just even like one game, Axie Infinity, like I learned so much about like tokenomics, like inflation, like overhype cycles. So I think there's so much to be learned and to be gained, even just from doing steps like opening like your first MetaMask wallet, like as Connor said, like doing your first transaction. I think that's the foundation before even thinking about what the metaverse is, because the metaverse is kind of like the sum of all these concepts, like cryptocurrencies, NFTs, and within those you have like different kind of like business models as we've seen, and it can get very kind of like complex. But I think the easiest way is to like go to the basics, think of like what are the primitive building blocks to get me to the knowledge to like see where to play, right? And even like the big players don't know this. Even JP Morgan, HSBC, they bought land in like Decentraland, but like there's still like no real like financial application yet. But I think that's a good sign to like kind of like get your feet wet. And it doesn't mean like buying something within the like a specific metaverse. It could even be something along the lines of like issuing your like own NFT. Like what would that look like? Could you rally like someone like around a specific cause around that, So I don't think you should like think of the metaverse like in its entirety, but think about portions of it. Like think about like what could NFTs do? Like what about like stable coins? Like think of like the components and how you can incorporate those into your business first before like tackling the whole metaverse in of itself. So I like to say like maybe just take like bite-sized chunks of it, like try to identify specific use cases that could really resonate with like your like your audience, your target market, your customers, right? For example, like using specific crypto rails for like internal payments, for example, or like cross-border payments, like what would that kind of like look like? Even that is like a step and a foray into it. So I think if you can focus on like what are the problems that consumers are having, like for example in the Philippines, no one has a bank account, so even having these like these crypto wallets which you can download off the web is like really good. Like is there some sort of like equivalent to do that? Like is there like a light version of a bank account which you could like use that has some of these web3 features but also has some protections, right? Like some sort of
Okay.
hybrid product, right? Is there something like that? So I think thinking along those lines, like what do your customers like specifically need, and like can you like look in the web3 toolkit to solve that, right? And we haven't, as Connor said, we haven't reached our broadband moment yet of what the metaverse is. So it's very hard to say like this is what you should do. But like I think this like small experimentation and like kind of like reading what others are doing, I think that's the best way to kind of upskill yourself on this. But yeah,
Okay,
that's my
thank you. Thank you, Eddie. Thank you for all the speakers, Ms. Helen Panzarino, Mr. Connor Svensson, and Mr. Eduardo Litonjua for the very insightful session and closing statements. Distinguished guests, ladies and gentlemen, we would like to inform you that OJK Institute has launched the mini site of OJK Institute that will provide access to various information regarding the financial services sector, such as capacity building, professional certification institution, and innovative and visionary research. For details, you may visit the link, or you may scan barcode on the Zoom screen to access the mini site of OJK Institute. Further, we can inform that we have shared a link feedback form in chat feature, and please fulfill before Friday, September the 16th, 2022 as a requirements to get e-certificate. You may also access today's materials through the link that have been shared by us through the chat column and OJK Institute media site on Friday, September the 16th, 2022. The materials and recordings at the OJK Institute media site can be opened in the capacity building menu, then choosing the Metaverse in Banking webinar. The materials will appear on that page. Ladies and gentlemen, thank you for 3,558 people who has registered at this webinar and 2,352 people who has attended this webinar. And from OJK, around 8%, government agencies around 4%, academy around 9%, and the others around 12%, the banking sector around 45%, the non-bank financial industry around 15%, and the capital market sector around 3%. Distinguished guests, ladies and gentlemen, OJK Institute would like to invite you to Perlindungan Konsumen di Era Digital webinar on October 6, 2022 at 9 till 12 a.m., which will be attended and opened by member of the Board of Commissioners of the Financial Services Authority in charge of Consumer Education and Protection, Ms. Friderica Widyasari Dewi. Reading become easier anytime, anywhere through OJK e-library. Ladies and gentlemen, and insan OJK who like to read, you can use the OJK Digital Library or e-library through the link elibrary.ojk.go.id. E-library provides various types of books that can be accessed by OJK internal and external. Insan OJK can directly access e-library by login using Office email and password. While for the external, you may first register your account through the register menu. So, distinguished guests, ladies and gentlemen, we have come to the end of this Metaverse in Banking webinar. On behalf of Indonesia Financial Services Authority, I would like to thank you for joining today, and we are looking forward to meet you again in the future. Wabillahi taufiq wal hidayah. Wassalamualaikum warahmatullahi wabarakatuh. Om Shanti Shanti Om. See you.
Thank you, Helen. Thank you, Connor. And thank you, Eduardo.
Thank you all the speakers.
Thanks for the speakers. Terima kasih Bapak Ibu anggota tim Fit and Proper Test. Nanti e-certificate bagi Bapak Ibu Fit and Proper Test kami sampaikan lewat DPIP ya Bu ya, e-certificate-nya.
Terima kasih
Ya.
Pak
Bagus.
Terima kasih Pak Agus.
semua.
Sama-sama Bapak Ibu.
Bapak Ibu semuanya, terima
Untuk para
kasih.
senior ya dan mentor kami.
Sampai ketemu.
Sangat hormat ya, para mentor dan senior. Terima kasih
Mas Agus. Pamit ya.
Terima kasih Bapak.
Terima kasih semua.
Bapak Ibu semua.
Agus, terima kasih.
Pak Hartadi.
Semoga sehat
Pak
semua.
Hartadi. Aku lihat Pak Hartadi.
Iya, dekat Mbak Ning fotonya. Aku foto
Aku lihat
tadi.
kuning, aku lihat Bu Harti.
Agus, sukses
Jaya
selalu ya. Aku lihat.
Bu Iwi.
Iya, Mas Agus
sehat
ya.
semua ya.
Iya, makasih banyak. Sampai ketemu Bapak Ibu semua.
Gayatri.
Kuning sehat.
Gayatri, Harti.